getting inflation down to 4% is not getting the job done.
They're going to knock down inflation. It's going to be painful, but they're going to get it down.
Inflationary pressures, both demand and supply, are leading to these bigger problems.
Maybe inflation is peaking, but it still remains way too high.
What I'm concerned about is that on the current regime, the central banks are set up to fail.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The Jackson Hole fallout continues, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Futures down 9/10 on the S&P. TK, an 8-minute speech sparks a $1 trillion market rout.
The shock when we realized how short the speech was, sitting there, and Mike McKee saved me. He said, I think it's going to end soon. And I'm like, really? And there it was. We were making jokes, John. I believe it was Wednesday evening with President George about Pivot the dog, which is her new puppy at the Kansas City Fed. John, this was one giant anti-pivot, and it continues this morning.
And that's exactly what Evercore are calling it, Tom. One priority, get inflation down. And if we're willing to accept a recession, they're willing to accept a recession. Tom, not just the Federal Reserve, also the ECB over the weekend. I think Isabel Schabel of the ECB with this quote right here. Even if we enter a recession, we have basically little choice than to continue our normalization path. That's the effort, Tom, from the Fed and the ECB.
We stopped the show now for all Americans on radio and TV that Ferro is not demanding that we look at the ECB. The fact is we must all look at the ECB. And, John, you see it with pound sterling well under 117. Pound sterling, on my moving average basis, is at post-Brexit weakness this morning.
And euro dollar just about holding on. Lisa, we need to talk about the prospect of QT, perhaps a move as big as 75 basis points on September 8th. And this bond market in Europe breaking down a bit again.
And the lack of predictability in this Fed meeting, there was a paper that was presented talking about the unwind of the balance sheet and how it could potentially lead to a lack of liquidity that was really concerning to the likes of Rajam Ragan of formerly the Central Bank of India. How do you sort of game out how this is going to play out at a time when central bankers globally, not just the Federal Reserve, are willing to accept the pain that it inflicts, because inflation was the one word that Jay Powell mentioned 45 times in an 8-minute speech. 45 times.
Really? You know who won't accept the pain? The politicians. Yeah. Did you get a glimpse of that over the weekend again from Senator Warren to CNN? This was the quote, Lisa. I am very worried that the Fed is going to tip this economy into recession.
We've been waiting for this, right? I mean, basically, this is the normal game plan, is that the Fed tightens, worries of recession build, politicians push back. This time, she is so alone. Who else is with her coming out and talking about that? I don't hear a lot of anti-hawks. Even as they say, perhaps you don't want to kill off the economic momentum, they still are reiterating inflation, inflation, inflation. In fact,
TK
45 times.
I've said it a few times, Lisa, and I appreciate the 45 times. I'm pleased you counted. I didn't. Tom, TK, you've waited for this moment where the politicians start to lean the other way. Is this the beginning of that?
Well, we'll have to see, and all of it folds into the election as well. What I would say, and this was a theme at Jackson Hole Unspoken, John overheard this in conversations where he was pretending to be a waiter at the famous Blue Heron bar. John, it's also about weak Asia and the current schedule to join us, and the ECB focus we're going to have to September 8th. Chairman Powell's getting no help on growth abroad.
Not at all. And he might get a little bit of help, Tom, by the BOJ, and we can discuss that a little bit later. Futures on the S&P 500 down 0.9%. On the S&P on the Nasdaq 100, we're down by more than 1%. The sell-off continues. Let's talk about the bond market. Yields up 7 or 8 basis points, 3.12% on a 10-year. Your 2-year, through the highs of the year, back to the highest levels we've seen, going all the way back to 2007. And the dollar, the strongest we've seen, Lisa, going all the way back to 2002. So cross-asset, there are some big things developing in the last couple of days.
The dollar is one of the biggest stories, and how potentially disruptive this is at a time when it is the only flight to safety that you see on a consistent basis. Yes, you could talk about the Euro Swissy, and I'm sure we'll talk about that significantly. However, this really is a massive and potentially disruptive story. Today, it's a light day ahead of a very big week of economic data in the United States. Today, Fed Vice Chair Lael Brainerd, one of the Troika, will follow up what we heard over the weekend, delivering pre-recorded remarks at a Fed Now workshop in Chicago. I want to hear about the balance sheet. We did not hear about the balance sheet in that 8-minute speech from Fed Chair Jay Powell, and yet there is this concern about what the effects, what the ramifications are of shrinking a balance sheet that has mostly only grown. It has not really contracted over the past few decades. The concern is it could remove liquidity from a market that already is trading at volatility levels that we have not seen seen for decades. I'm not talking about the VIX, I'm talking about other measures. Today, also, German Chancellor Olaf Scholz traveling to Prague to speak with the Czech Prime Minister, talking about the energy crisis. You are seeing natural gas prices in the Euro region fall off a little bit today. Not so much German power costs. It is a controversial measurement, but still, the chart is shocking. It is exponential. This looks like something that you would see in a parabolic kind of function in your math class. And at 10:30 a.m., we get U.S. Dallas Fed manufacturing activity for August. And I mean, we could be saying that it's Dallas manufacturing Monday, but really this issue is it's before the ISM manufacturing report on Thursday, which actually, John, is important. It is something you have picked up on, especially after the really dreadful manufacturing numbers that we've gotten recently, that people just shrugged off as not that significant.
Lisa, I don't think Dallas Fed manufacturing Monday is going to catch on.
Just not too catchy.
Just going to throw that out.
Well, I mean, we could try. I mean, every data point's important.
I'm not coming along for the ride with you. Lisa, I have to say, how much nicer is it, Tom, back in the studio? Warmer?
Oh, yeah.
Isn't this
And
nice?
it's only 50 degrees here. You know, folks, you should have seen it. Abramowicz starts in at the Blue Heron Bar in Jackson Hole with the Nerd Fest you just heard in the morning brief. John, the bar came to a complete halt.
As soon as Lisa
There
walked
was just
in.
silence.
Yeah, everyone's
she
like,
started
please.
it on
Like pounding
parabola,
drinks.
x squared plus y squared equals 1 or something. And she says, look at the unit circle. And I mean, it just was a complete
I think you're
halt.
describing yourself and not Lisa. Win Thin
Thank
joining
you.
us now, Global Head of Currency Strategy at Brown Brothers Harriman. Win, let's start here. What changed for you over the weekend?
In a word, nothing. The only surprise to me was how surprised the markets were. I mean, this was a culmination of an aggressive, coordinated, well-orchestrated communication effort by the Fed. And they've been saying this for the last 2 weeks. We are keeping on this hiking path. We may see a recession, we may not, we hope not, but we're hiking. And Mr. Powell really just pretty much summarized that whole message in, as you point out, 8 minutes with many mentions of the word inflation. And I think it's been consistent. I think it's the right message. It's probably not the message that equity markets wanted to hear, but that's the right message at this point.
When what we have seen in the last 24 hours is a reaffirmation of strong dollar. There's any number of ways to measure this, but with your decades of work, the Bloomberg Dollar Index really captures EM. BBDXY is out to record strength this morning. What does that symbolize?
Well, it does symbolize that emerging markets will remain under pressure. I've been sounding like a broken record, and I apologize, but, we have global tightening, weaker global growth. That is not the environment for emerging markets and other risk-type assets. But in particular, emerging markets, look, they can see some pockets of strength. Some of the commodity exporters have been doing well, but we've seen really a flight to quality. There's been massive outflows from EM. We saw a little bit of inflows in August, raised some hopes, but that was really, I think, a head fake. It's hard to say, yes, load up on EM right now. Eventually, when we get near the end or towards the end of the Fed tightening cycle, maybe we see some stabilization economic data worldwide. We might see a slight bid for emerging markets, but I would stay out of the way right now.
And Lisa, are we on the 7 yuan per dollar watch? I think all of a sudden we are out of Beijing.
Perhaps, although Leland Miller does not think it's that significant, considering that this is not an issue for a lot of Chinese officials, that the strength of their currency is not what they're necessarily going to hold on to, given some of their other issues. As we look at the flight to quality, as we look at the dollar strength, at what point does it become profoundly and structurally disruptive, akin to what we saw in March of 2020, when the Fed was forced to step in a way where perhaps it will not this time?
Yeah, so we have to look at, I think, in sort of two spheres. Obviously, the dollar strengthening at the majors is undesirable for those countries like the Eurozone that are trying to fight inflation, because the weaker currency feeds into inflation. But in general, you don't look for crisis of any sort. Yes, they'll be under a lot of pain, recession, et cetera, but it's emerging market, the real pain points, right? That's where we talk about solvency issues, liquidity issues. So for every percentage point or 5 percentage point weakness in the currencies of emerging markets, it makes it that much more difficult for them to service external debt. Dollar issuers are safer because they have for instance, the commodity exporters have a dollar supply. But if you're a local currency issuer in, say, Brazil, and all of a sudden your revenues are the same, but your payments in dollars become 10% more expensive, you're coming under a lot of stress. So look, we've already seen this in a lot of countries, the frontier countries. They're sort of the canary in the coal mine. Sri Lanka, Pakistan, now we've got Egypt having problems, some other countries in Egypt. Is it a contagion? Well, I hesitate to use that just because the fact is that we're in this incredibly negative environment that's going to pressure the weaker links. I think the stronger links in the EM will ride this out, but the weaker links, especially in frontier markets, are really going to come under pressure. I don't think it's going to be systemic risk, but we will see more and more countries come under pressure and really face some really, really difficult times.
Within some difficult decisions to be taken this year, that's for sure, of Brown Brothers Harriman. Thank you, sir. Chairman Powell, for many people, delivering the speech that they expected, the pushback for many people in the equity market, maybe the speech they were hoping he wouldn't deliver. Equities down by 0.9% on the S&P. Lisa, this line from Chairman Powell, estimates of longer run neutral are not a place to stop or pause. Was this the cleanup act for that news conference a few months ago?
So some people are coming out and being hypercritical of the fact that it was not a mea culpa. It wasn't necessarily a full-on repudiation of some of the errors of the Fed's past ways and past assumptions. However, yes, I mean, this is basically going exactly in opposition to what a lot of people got from the last meeting, including, we're going to hold them there for a long time, guys. We're not going back to lowering rates anytime soon. It was consistent. It was from every Fed official we spoke to and reiterated again from Fed Chair Jay Powell.
It's easy to shake off some of these comments, Tom. They will take on renewed importance when we start to get a labour market that looks like it's breaking down. Unemployment's at 3.5%. When we get to 4%, how can they convince people, the general public, that a higher unemployment rate is worth a price worth paying to get inflation down? That's where things start to get a little stickier for this Fed.
In terms of data dependency, two ideas. One is John Hilsenrath in the Journal this morning on global domestic income, and the other, John, is a non-farm payrolls coming out Friday. We migrate 285-ish out to a new 300,000 number. Wow.
Peter Chair's going to have thoughts on that of Academy Securities. He'll join us in about 50 minutes' time. Futures down 0.9%. The sell-off continues. Hello, Monday. Good morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. NASA is about to take the first step on its journey to return people to the moon by the end of the decade. The unscrewed Artemis 1 mission is set to lift off today from Kennedy Space Center. It's scheduled to circle the moon in an orbit that will take it deep into space and then return to Earth 42 days later. Earlier today, engineers were checking a leak affecting the hydrogen tanking process, which had already been delayed by bad weather. U.S. Navy warships have sailed through the Taiwan Strait for the first time since House Speaker Nancy Pelosi's visit to the island. That trip strained relations between the U.S. and China and led to Chinese military exercises around Taiwan. The Navy says its ships were demonstrating the U.S. commitment to a free and open Indo-Pacific. European Central Bank Governing Council member Martin Kazak says interest rates should be raised by at least a half point next month. Kazak is urging the ECB to show a resolute response to soaring inflation. The Eurozone releases its latest inflation data on Wednesday. And in the UK, the front-runner to become the next Prime Minister, Liz Truss, reportedly is considering slashing the country's value-added tax by as much as 5 percentage points. The Telegraph says that could head off criticism she doesn't have a plan to tackle the cost of living crisis. Credit Suisse is reviewing the long-term plans for its business in mainland China. It's part of a broader strategy revamp after the lender racked up billions of dollars in losses. Bloomberg's learned that Credit Suisse executives are meeting in Singapore next week to discuss topics, including their view on the China business. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy.
Hello, 2023. Love Chairman Powell. Jerome Powell there, the Federal Reserve Chair in Jackson Hole going into the weekend, pushing back against anyone thinking you get rate cuts anytime soon. Futures down almost 1% on the S&P 500, on the Nasdaq down by more than 1% on the Nasdaq 100. Yields are higher by 7 basis points on a 10-year, 311.55 on a 10-year. Your 2-year through the highs of the year, very close to 350 a little bit earlier this morning on a 2-year maturity. The highest yield going all the way back to 2007. Levels we haven't seen since 2002 on the dollar index. Euro dollar just about holding on. 99 67. TK, a story that slipped under the radar last week was this one right here. A letter sent from Secretary Granholm to energy players in the United States of America concerned about low stockpiles of gasoline and diesel, historically low levels in the Northeast, and saying this to them, Tom: it is our hope that companies will proactively address the need. If that's not the case, the administration will need to consider additional federal requirements or other emergency measures. Tom, what do you make of that line and the prospect that maybe we start to think about curtailing, perhaps even banning, fuel exports?
I think the surveillance has been out front of this, John, and particularly with Stephen Shork of Philadelphia, who knows every valve in New York Harbor. John, it is a tangible issue, but you wonder if the Secretary of Energy consulted with the Secretary of State before that release.
Or even the White House and the President of the United States, Tom. This is going to get tricky when the Europeans, Tom, really face the crunch later this year.
Well, I'd say the crunch is here right now. That's one of our themes here as we look to the ECB. Again, for our American audience, we are truly focused on European affairs out to September 8th. It may seem a little distant from America. It's not. Right now, in the distance in Washington, Jack Fitzpatrick joins us, Bloomberg government. Jack, I want to go to where President Biden is right now. It sounds to me like he should be taking a subtle set of victory laps now. Is he, or is he so beleaguered he can't enjoy the moment?
It seems like he is taking a bit of a victory lap, and Democrats heading toward the midterms are playing up their legislative victories, the fairly good economic news lately of gas prices going down a bit. And it does make sense for them to do that now, considering, you heard Senator Warren saying she's concerned about a potentially somewhat severe recession or millions of jobs lost down the road, depending on what the Fed does. So I think they're in the moment where they can take a bit of a victory lap because they've gotten a good chunk of what they've wanted to get done legislatively. They've had some fairly good news, but there's also a sense that there's potentially some bad news on the horizon, and Democrats are probably hoping that waits until after November.
The senator from Vermont, Patrick Leahy, flogging a book this morning. We're thrilled that the senator will join us here in the 8 o'clock hour. Give us an update on the strength of liberals, the strength of progressives within the party. I mean, they got the vice president and they got a victory lap with student loans. But what is the voice of liberals, like the senator from Vermont now, as we go into the election?
Senator Leahy's an interesting one. I think, one, big picture progressives, yes, they can be happy about what they got on student loans. They wanted more. They probably should be happy with what they got in the remnants of the Build Back Better agenda, because that was a significant bill despite it being pared down. Senator Leahy is in charge of appropriations in the Senate, and I don't know if there's any spending deal on the horizon. They seem to be moving pretty slowly. They would need that to follow up on the measures in the CHIPS bill that they got that is largely authorizing measures, and they need to fund it in order to make it fully accessible. So Senator Leahy in particular has a lot to do over the next few months that is a significant challenge that could follow up on some of their victories. But it's a mixed bag for progressives overall.
Jack, just quickly here, I want to finish up where John was beginning. This question about the domestic agenda and how that pairs with the international attempt to truly shore up friendships with alliances. How much is the U.S. going to double down on exports of natural gas to Europe ahead of this winter that is going to be very difficult in the face of the Russian invasion of Ukraine and some of the questions around the pipeline, the Nord Stream 1, that goes into maintenance later this week? How much is there a conviction in Washington of the importance of continuing these exports and continuing the support of Europe?
There is enough of a conviction so that story a couple days ago on the Department of Energy letter was pretty surprising. It does seem to be in a serious contrast to what the administration has talked about in the realm of foreign policy. There really does not appear to be a flagging in the support for measures that not only Ukraine aid measures, but energy aid measures to Europe in response to the invasion of Ukraine. So the Department of Energy letter might be an outlier, and if you talk to foreign policy people, lawmakers in Washington, it seems there's still a good amount of support for energy exports.
Jack, thank you, sir. Jack Fitzpatrick. Lisa, the big issue, as you know, is how do you balance the domestic economic tension with the foreign policy issues? And I think that captures it perfectly well.
Well, and we saw this when the Freeport LNG export facility in Texas went down because of some disruptions, and that is 1/5 of the exports to Europe. And we saw that actually lower natural gas prices in the U.S. And some people started saying, "Well, let's do this." And other people, Biden in particular, coming out and said, "Absolutely not. We need to support our allies." How much does this create a tension between his energy secretary and him?
Do you think the energy players are going to listen to Secretary Granholm anytime soon?
No. No, I mean, also, it's not clear that she has the power behind her of even bipartisan support or even partisan support from the Democratic Party. So why are they going to follow that? But that really goes to this sort of policy uncertainty that a lot of these energy players are feeling.
Let's get to the market uncertainty. Equities are down by 9/10 on the S&P. If you're just tuning in, the Nasdaq lower, Tom, by more than 1 full percentage point. If you listen to TK and you went to cash, probably happy you went to cash many times this year. Tom, yields higher on a 10-year, on a 2-year, on a nominal basis. And Lisa put out a great chart earlier this morning. Real yields this year, Tom. Brutal.
Yeah, real yields are there and they're breaking higher. John, by the time you get to the real yield, folks, look for it this Friday. You may break out to a new high, which I'm going to eyeball at 70 basis points back to 2018 above 1%. We're nowhere there yet, but the fact is a 10-year real yield on Friday moved.
We've got to catch up with Andrew Sliman and Morgan Stanley Investment Management.
Yes.
We'll do that in about 5 minutes' time. Equities really on the move once again, adding to the losses from Friday, waking up Monday, more of the same. On the Nasdaq 100, we're down by more than 1 full percentage point. On the S&P 500.
No, I don't want hot tea.
Down 9/10 of 1%.
I don't need clothes.
Rama, I think London's got the right idea this morning.
Cinema.
Take the day off.
Yes, I would agree.
Take the day off. Take a long weekend.
Everyone.
From New York, this is Bloomberg. It is the J. Powell route from New York City this morning. Good morning. It continues on the S&P 500. Futures lower by 0.9%. On the Nasdaq 100, down by 1.15% after Friday's losses, the biggest one-day drop since the middle of June. Bear in mind that even after Friday, we're still 10 to 11 percentage points higher than the June 16th low. Meanwhile, the bond market has already taken out the June 14th high. On a 2-year, we do that this morning. Let's take a look at it. Earlier in the session, 348. Right now, through 345. That takes out the June high. We have to go all the way back to 2007 to see your 2-year right here at 345.79. So yields up on 2s, yields up on 10s by 7 or 8 basis points to, let's call it, about 312. And it's not just the US. Take a snapshot of Europe. In Italy, in Germany, yields higher. And it wasn't just the Fed that pushed back as well. It was the ECB too. Are we going to consider QT and a 75 basis point hike from this ECB on September 8th? You've got yields up in Italy, Tom, yields up in Germany, and for once, just a little bit of euro strength in the mix, 99.86.
John, the likelihood of the 75 beeps and the ECB not having an effect is about the likelihood of stopping a Harry Kane penalty shot. It's never going to happen.
Is that your summary of things, Tom? And then it happened.
No, but then it happened. And that, my point here is we need to be prepared for the unexpected in Europe, whether it's 50 beeps or 75, because Lagarde has to frame out what the end of the year looks like. Do we know what the end of the year looks like?
I don't know what next week looks like, Tom.
Yeah.
Never mind the end of the year. What I do know is what they're telling us, Lisa, and what they're telling us right now over at the ECB is that even if we have a recession, we have to keep on going. We have to keep on going.
There is a penalizingly high inflation rate that they are committed to getting down. There is a unified message, not just among the Fed, but also central banks around the world. This is the primary concern, inflation, even as they see the concerns of woes, which raises a question going back to your first point with stocks. Why are they not more concerned about the consequences to earnings from slowing growth?
Mike Wilson of Morgan Stanley is. You read that note, I read that note. That was the pushback. Tommy said the first half was all about Fed rate pricing, Fed rate risk. The second half is going to be about earnings, and he thinks there's a lot of space to the downside there.
What we're going to do this morning, folks, and this is, of course, the combination of equities, bonds, currencies, commodities, is consider the bears who've been successful. Douglas Cass nailing it at Seabreeze on a short-term basis. And as John mentions, Mr. Wilson over at Morgan Stanley absolutely nailing it on a more long-term measured, let's call it institutional basis. In the storm is Andrew Slimman, Mr. Wilson's colleague, senior portfolio manager at Morgan Stanley, Chicago. Andrew, thank you so much for joining us in this turmoil. You go as a guy more optimistic where Mike Wilson goes, which is now we must study earnings. And you suggest that margins must be maintained. Can we be optimistic for maintained margins through the end of the year?
Well, we certainly haven't seen the earnings collapse that many of the bears have predicted. We'll have to see. I would say from a stock picking standpoint, it's better to find the companies that actually already have had the earnings collapse. I think he's talking at the S&P level. We'll have to see. The counter argument is that we are still only 2 years from the previous recession, and therefore balance sheets can withstand the shocks that you're seeing to costs and so forth better than they would if we were, coming off a long period of economic prosperity.
With a 2-year back to an autumn 2007 yield, is cash attractive as a legit asset?
Yeah, yes. And the point of this is I am in the camp of PE compression. So I think that is the negative. The Fed raising rates, yields going up, pushes the PE down. And that's the negative that I see. I just haven't embraced as much the earnings collapsing side, which is the positive. And that, to me, has been the story of the year. And we got a little bit, we had a very big bounce off the June low on the fact that the second quarter was not as bad as expected. And, now we're pulling back. That's the push-pull of, they're very much a lackluster year for equities, and I'm still in that camp.
Andrew, as you know, the bond market backdrop changed as well since the middle of June. It's back to where we were. So here's the question about the June lows in the equity market. If the 2-year yield is back through the June 14th highs, why do equities belong anywhere near 10% above the June 16th lows?
Probably not. They probably will head lower. I think, September is not a great month, but I still think we could get a, late rally in the fourth quarter as the market starts to price off, next 4 months, next 4 quarters of earnings, which is 2023. But, look, we've had a big bounce. High risk came back in the market very quickly. And I think that's, that was a dangerous sign. So Jerome Powell getting up and saying what he said, and boom, down goes all the speculation that had come quickly back in the market. So I think the near term it's negative for the market. Will we hold the lows of June? I think it's possible, even with rates higher. But I think speculation is ripe for short-term speculation, right, to be, washed out.
So you sound really bearish, Andrew, and you're talking about reducing risk. And then I look at some of the stocks that you like, including Restoration Hardware, Lululemon, among other consumer discretionaries that usually do worse during downturns. What gives? What's the rationale?
Yeah. So first of all, at the macro level, consumer sentiment hit a 44-year low in July. So a lot of very negative views. And when you think about that, it's all the stock market rewards the direction of change. And so inevitably, direction change, it's got to go higher at some point. It has. Sentiment has improved. And then from a stock standpoint, those stocks are down 40, 50, 60, 70% peak to trough. There is just a ton of bad news priced into it. So I guess going back to the original question of earnings, these companies have already brought down their numbers. The market is pricing in as if they're going to miss earnings. So I think that it's safer to buy companies that have already, the expectation is bad. I always am interested in buying companies with great long-term track records that the stocks are down a lot with a lot of negative expectations. So I think that's safer than thinking you can pick and choose companies that aren't going to have earnings problems.
Following that logic, Andrew, do you think that the opposite holds true, that you should sell the names that have held in better? I'm thinking of big tech that have had incredible rallies over the past few months.
Absolutely. I think it's very dangerous. Be careful if the Mike Wilson scenario comes to bear. I don't want a stock that's down from its peak, 5%. I think there's a lot of risk in that area, and I'd rather buy the companies that are already priced in a lot of bad news.
How do our listeners and viewers do, Andrew, if everybody's buying 4 or 5 stocks, which were X% of the bull market rally out of June, and then you've got to look at everything else? Do you participate in those glory stocks and figure out what to buy? Or do you finally jettison the glory stocks and actually run a diversified portfolio?
Well, yeah, I mean, I think there's plenty of companies out there that are down, a lot, as I said, and there's real opportunities. But those very big stocks, some of them are really not down that much. And if you go back and look, Tom, at the history of the S&P, what brings down the largest companies? They never stay on top forever. It's usually the government. And I think you've got a very high weighting in a few names, and that is going to weigh on the S&P at the index level, I think, for the next few years, which will be good for investors that go out and buy individual stocks, because I think the opportunity set is probably better at the stock level than the index level, just given the weighting in those few names at a time when the government is, like I said, starting to, nose in some of these companies.
Andrew, got to squeeze this in. Energy, winner of the year at 49% on the S&P 500. Jeff Curry and the team over at Goldman. They're telling people to keep buying commodities, even going into what could be a recession. They say the following: commodities are the best asset class to own during a late cycle phase where demand remains above supply. Andrew, where are you on the commodity equity side of things, the energy equities, which have delivered some stellar returns this year?
So Lisa listed some stocks that we like. We got to sell something to buy them, because I'm a long equity manager. What have I been reducing? Energy. And I've been reducing energy because just what you said, it's up significantly, 49%. This industry is classically cyclical. And if, in fact, the economy does weaken, to me, energy is vulnerable because it's done so well versus stocks that, were listed that are already down a lot. So I think energy is a source of funding. It's come roaring back here. I would continue to view it as a source of funding. So I'm, the fat pitch in energy was a year and a half, 2 years ago, when the forward curve was negative
prices.
I think the fat pitch right now is that sentiment is at a 44-year low. I think that's the opportunity, and you sell things that are done very well, like energy.
Andrew, thank you. Andrew Sliman there of Morgan Stanley Investment Management. TK, his view: sell the energy winners and allow that to fund some of the beaten up players in retail.
Everybody talks about buy low, sell high. And what's really, really difficult to do, John, is to sell high and then rebuy low.
Yeah.
Way, way harder.
I couldn't agree more, Tom.
Was that smart? Did I
Always
do that
great
okay?
with hindsight to look back at that moment in spring of 2020 and say, that was the easy point to put some money to work. Lisa, it didn't feel that way at the time, did it?
Yeah, the easy money was made right after that. It felt really easy. I kid, especially after trading was halted for however many days in a row. What he's talking about, though, is really controversial, and I'm glad you brought up the Goldman point. People saying that a recession will dampen the prices of oil and gas. That's the Andrew Sliman potential point of view. And then others saying there still is demand and not enough supply. Period, full stop.
You know why Resto works? RH always delivers on time. They're so
when
good at
have you ever bought something from Restoration Hardware?
John, plenty of times.
Really?
Yeah, of course.
John, we got to
deliver on time. Their logistics through this have been so much better, Tom, than everyone else.
That's true.
Everyone else I've dealt with. This is very personal.
Okay.
I'm surprised.
John,
you're a fan of Restoration Hardware.
Is she gloomy or mountain time or Eastern time?
I actually would like to
I think she's still on gloomy mountain time, Tom.
Yeah, I think it's mountain gloomy time.
Without a doubt. Lisa didn't get
left.
any rest this weekend. Futures down 9/10 on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Senator Elizabeth Warren has taken aim at the Federal Reserve's plan to fight inflation. She told CNN she's worried the central bank will tip the economy into recession. Warren said there's something worse than high prices in a strong economy, and that's high prices and millions of people out of work. If an Iranian nuclear deal is reached, Tehran may be able to put millions of barrels of oil on the market almost immediately. It's estimated that Iran has up to 93 million barrels of crude stored on ships in the Persian Gulf, off Singapore and near China. A nuclear deal would most likely lead to Iran being allowed to sell oil globally again. In California, Governor Gavin Newsom has introduced a bill to keep the state's last nuclear plant open. Newsom argues that keeping PG&E's Diablo Canyon plant operating past its planned closure in 2025 is needed as the state transitions away from fossil fuels. Still, Newsom's fellow Democrats in the legislature are skeptical. Honda and South Korean battery maker LG Energy Solution will spend $4.4 billion to build a battery factory in the U.S. The Japanese car maker wants to phase out fossil fuel vehicles by 2040. The location of the plant hasn't been decided. Bloomberg reported in June that Ohio is a front runner. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We can't just rely on markets. We have to get our rate up to the level that will put downward pressure on inflation. I've said 3.75 to 4% by the end of this year. I'd like to get to that level, and sooner is better as far as I'm concerned.
The St. Louis Fed President Jim Bullard there catching up with us, going into the weekend on Friday in Jackson Hole. From New York City this morning, good morning with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures are negative again, down 8 or 9% on the S&P. On the Nasdaq 100, down by 1 full percentage point. Yields are up by, let's call it 6 or 7 basis points on a 10-year, through 3.1% at 3.10. 6-1 on a 10-year in America. TK, Chairman Powell on the neutral rate. Jim Bullard very much on the same page. President Bullard didn't even want to talk about where he thought the longer run neutral rate was. I don't think he thinks there's much value in that exercise right now when they have so much work to do. I think Chairman Powell framed it quite nicely in the speech as well. Estimates of a longer run neutral rate are not a place to stop or pause. I'm not even sure they're relevant right now, Tom, to this big debate.
Yeah, that's the key phrase, John. Relevant now, they're not. And also, it's very squishy math and a really uncertain time. But what was so interesting with Bullard, John, is his idea of a regime change 7, 8, 9 years ago, whatever it was. And you wonder if we're at a regime change right now.
Elisa tried to drive that home a couple of times. I'm not sure they want to jump on board with that just yet, Tom. They're talking about raise and hold, but this idea that perhaps this is the new regime of higher inflation and higher rates, and we could be living with it, Tom, for a whole lot longer.
We'll have to see. If futures at negative 34, the VIX out almost 2 points, 27.21. Some legitimate tension with record dollar strength off the good Bloomberg Dollar Index. Part of that, of course, is commodities. We're looking at all the asset classes this morning in this turmoil, this reset into the end of the year. Ellen Wald provides advice, senior fellow at Atlantic Council, I should say, in her definitive efforts, Saudi. I can't say enough about the terseness of her book, Saudi Inc. Just a really wonderful walkthrough of the originality of what we see in Riyadh. Ellen, I want to talk what John mentioned earlier, which is the idea of the U.S. as a global manufacturer of hydrocarbons, and a select few saying it's un-American to export the stuff. Discuss that as the adult in the room.
Yeah, I can understand where these people are coming from, especially because for so long we did have a crude oil export ban, but you have to remember that really is only a very recent phenomenon. We only had a crude oil export ban starting in the 70s during the when we had the oil shocks, and the idea was to try to keep as much oil as we had at home. Before that, America was a major supplier of energy to the world. Basically, during World War II, American crude oil, American energy, American gasoline and diesel and jet fuel was essentially, you could argue, responsible for winning World War II for the Allies. So I think to say that it's un-American to export our energy products is a very short-sighted view of America.
So, Ellen, the Department of Energy led by Secretary Granholm, appears to be very concerned about the low stockpiles of diesel and gasoline, particularly in the northeast. This is what she said in a letter to some of the energy players here. It is our hope that companies will proactively address this need, or, quote, the administration will need to consider additional federal requirements or other emergency measures. Ellen, how credible is that threat?
I mean, if that's not a threat, then I'm not sure what is a threat. I mean, she pretty much laid it out, saying if you don't get American stockpiles up, if you don't stop exporting products that are, commercially viable to export, then we're going to, ban the export of certain products. And that's, I think, very damaging to the global energy market, because the United States is an important participant in this global energy market. And we import tons of products as well as we export them, and that's what helps things run smoothly. Right now, the prices in Europe for diesel, for liquefied natural gas, for all sorts of products are much higher than you can get in the United States. And so that's why we're seeing a lot of products go to Europe, especially because Russian products are no longer available for these places to import. If, we wanted to correct this, we could stop, sanctioning Russian exports, or Europe could take a hard look at it. It's the answer to this problem is not to say don't export or we're going to ban exports. The answer is to look at the larger flow of products and figure out, where things could be improved. For example, they could get rid of the Jones Act or suspend the Jones Act, which would make it much easier to transport diesel from certain places in the United States to the eastern seaboard, where diesel supplies are very low.
Well, there's a question about whether Jennifer Granholm has credibility within the energy industry at this point. We could get into that. Perhaps a little more instructive is what companies are actually doing, whether they're going to actually invest in producing more natural gas, producing more crude products in the United States. What do you see on the investment side at a time when prices, while they have come down, are still much more elevated than they have been in years?
You would think that ordinarily when prices are high, that there's a much higher level of certainty for producers to say, okay, we're going to invest, we're going to produce more. But right now, at least according to the survey that the Dallas Fed and other Feds have done of energy producers in their regions, show that actually there's a very high level of uncertainty. And a big part of that has to do with inflation and supply chain issues. A lot of producers are finding that while they thought that their costs would go up maybe 10%, they're finding that costs are up 25% or higher. And that's really hurting their ability. Even those that want to produce more, that want to drill more, that want to open more wells, they're finding that this is very difficult. They don't know where they can get the steel. They don't know where they can find labor and sand and other inputs that they need in order to get these wells going. So wells are taking at least 7 to 8 months to complete, whereas before that timeline was much, much shorter.
Can we just probe the tail risk here, just to wrap up, Ellen? What do you think would happen if the administration curtailed the export of fuel, of energy product to, say, Europe? What would happen? What would the main characteristics of the energy market look like in that world?
I think that the first thing we would see is a major, major spike in the price of fuel products and oil all over. I mean, speculators would just, ramp things up. I mean, it would be such a high, increase that maybe the likes of which we've almost never seen, or at least even if this was just foreshadowed, we'd see a jump in prices. And then we'd probably also see some issues in terms of WTI, that we'd see a much bigger differential between Brent and WTI developing.
Ellen, thank you. Ellen Wald, the Atlantic Council. I'm not sure that's the base case yet, Lisa, but it's certainly the tail risk, and that tail risk has been highlighted by Secretary Granholm in the last week.
You could say that she's not credible, that she does not have the support of the administration, but why is she still part of the administration if she's going to come out and send a letter like this to members of the oil and gas community, basically saying, you're issuing a threat?
Then that's a question for the president, Bramo. I'm not sure I can answer that one.
Well, but I guess that the question that I have is, okay, is this a tail risk? It's not a base case,
sure.
But then why is she putting it out there? What is she hoping the response will be?
Tom asked a similar question earlier. TK, when you said, did the State Department know about that letter? Did the White House know about that letter?
It's politics. You're going to get competing forum. And let's remember that she is the former governor of Michigan, so she's adept at the political debate of the moment.
Futures down 0.8% on the S&P from New York. This is Bloomberg.
Getting inflation down to 4% is not getting the job done.
They're going to knock down inflation. It's going to be painful, but they're going to get it down.
Inflationary pressures, both demand and supply, are leading to these bigger problems.
Maybe inflation is peaking, but it still remains way too high.
What I'm concerned about is that on the current regime, the central banks are set up to fail.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Still shivering from sitting out in that field for 5 hours. Live from New York City this morning. Good morning, good morning. For our audience worldwide, with Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. This is Bloomberg Surveillance with equities down 0.9% on the S&P 500. TK, the J. Powell pushback. Here's the fallout.
Well, there it was. I mean, remember, John, when he spoke and we were sitting there in the ice looking at a modest market reaction. Boy, John, what a reassessment as we went out to get back on the Gulf Stream.
Ripped the floor out of this equity market, wow. Tom, and then adding to it, the ECB over the weekend, TK. The ECB and the Federal Reserve with a similar message. Even if the economic growth looks weaker, we'll keep hiking to get inflation down.
And this is really important. We've mentioned it twice before, and we'll mention it through the week. Right now, for those of you in America, ECB really matters. We've got the expertise of John Ferro before he could drink in a pub, servicing in Frankfurt. And John, is this ECB, John, anything like the ECB that you knew long ago and far
radically
away?
Different. For one, Tom, it's hiking interest rates, and the whole of the previous cycle, they didn't do that at all. Back to Trichet in 2011, he was hiking interest rates, but inflation, Tom, then was closer to 2%, and this one is closer to what now? 8%, 9%, pushing 10%?
But the same question is there. How do they hike into Eurosclerosis, even if it's war or no war?
They're telling us they'll hike into recession, Lisa. They're telling us that they will hike even if it looks like we're in a recession. That's the communication, not from some random governor of some random place. It's from the board, the executive board of the ECB.
Perhaps it's easier, though, to talk tough than to do it. And this is really going to be the key distinguishing feature going forward between the bulls and the bears. At least that's the camp that we're seeing right now. Whether people believe that they've fed, whether the ECB will follow through on tough actions. And Bill Dudley wrote a column to this effect this morning, basically saying they need to follow it up with actions, even as they will have hiked rates by 275 to 300 basis points in 6 months. Just giving you a sense of how much the scope has been and how much it needs to be.
What did you make of the length of the speech? 8 minutes, very targeted, very concentrated. Did that work for you?
He laid it out in the beginning. He said, I want this to be focused. I want it to be clear. Inflation, 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 plus 42 other times he mentioned it. And then guess what, guys? We're going to do what we have to do.
John, as I went out of the lodge with my entourage, not one but two former Fed officials stopped me and emphasized how much they agreed with the brevity of his speech.
I think everyone's on the same page after that, Tom. And I think for a lot of people, the criticism came from the performance in the news conference at the last Fed meeting. And it is littered with quotes, literally littered with quotes, Lisa, addressing some of the issues that were raised after that news conference.
Basically saying we're going to do it for a long time. Basically, read between the lines, we're not going to cut rates. Read between the lines, we're not going to back away if the economy does turn. But what about the balance sheet, which they did not mention? What about what they got wrong in the assumptions? They also did not give a sense of. And what about the framework that they will look at this data in their data dependency?
That's the essence of the Mohamed El-Erian piece in the Financial Times.
Correct.
It's not just about the present, it's about the past, it's about the future, and we can pick up on that in just a moment. Futures are down about 1% on the S&P 500, on the Nasdaq 100 down by 1.16%. So equity softer, lower, negative. We're heading south. Yields heading higher, up by 6 basis points, 3.1% on a 10-year, 3.10 to 4%. And an ECB, we're not just considering a 50 basis point hike. We might be talking about a 75 basis point hike. Lisa, and QT, euro dollar, firmer, 99.85.
Yeah, it's really shocking considering where the ECB has been, even possibly more shocking, at least in a divergence from negative rate policies than over in the Federal Reserve in the U.S. Fed Vice Chair Lael Brainerd today is going to be delivering remarks at a pre-recorded event at FedNow in Chicago, a workshop there. She will talk, I'm sure, about what Fed Chair Jay Powell said over the weekend. I want to hear what she has to say about the balance sheet. It is going to ramp up in terms of its unwind. And there is a lot of question around what the impact will be, especially because there was a paper that was presented at the conference. And basically, the nut of it is it will introduce a lot more liquidity concern, Tom, that people are not perhaps expecting.
Well, John, we'll have to see. I mean, was there any talk of the balance sheet anywhere? I mean,
we talked about it a little bit in some of the interviews of QT, but I don't think they understand the consequences of QT, reducing the balance sheet by $1 trillion and what it will mean for financial conditions. So I don't see how they can make a call on what QT means, Lisa, for this market and ultimately what it means for rate hikes.
And ultimately when they will stop if they see some of the constraints with liquidity. Also today, German Chancellor Olaf Scholz is traveling to Prague to speak with the Czech Prime Minister. Front and focus very much the energy crisis. We are seeing a little bit of a reprieve in natural gas prices, but German power prices, power valuations still skyrocketing at an exponential pace. And at 10:30 a.m., we get U.S. Dallas Fed manufacturing activity for the month of August. I know you all have been at the edges of your seats for this report. Perhaps not one of the most important data points that the Fed is tracking. However, perhaps a hint ahead of the ISM manufacturing report on Thursday. And John, you've talked a lot about what will it mean if you start to see that material slowing in the economy. Then the proof is in the pudding, right? Then the Fed has to respond and continue tightening, even in the face of weakness, which becomes a much harder task.
We ignored the S&P Global PMI.
Completely.
I don't think anyone's going to ignore an ISM if it looks like that. Lisa, thank you. Let's get to Peter Cheer, the head of macro strategy at Canopy Securities. Pete, let's start here. The Fed is telling us that they will keep hiking rates even in the face of weakness. Do you believe them?
To some degree. I think what they've done is shift really the scale. So if we got bad economic news, say on a scale of 7, the Fed might respond in terms of an 8 or a 9. Now they might respond in terms of a 4 or 5. So they will continue to hike with some bad economic news, but they will not be over the top, right? If we really get weakness, if we get jobs going down, they will have to backtrack. This was really about resetting expectations. They had a perfect opportunity. They did that. They'll continue to do that this week. But the reality is they are going to be data dependent.
Well, they're going to be data dependent, Peter, but which data? I'm confused now because I've got equities moving, bonds moving, currencies, dollar out to record dollar strength, and even commodities giving me some movement as well. Which data dependency matters to the Fed?
I think jobs are going to be important. I think, to me, they're going to start watching this inventory build and whether that translates into lower economic output. And then finally, we do have 2 threads, and I think you did a great job mentioning this earlier. QT is starting to ramp up, and I think QT behaves very, very differently than rate hikes. I think QE really helped inflate all asset prices. I've always talked about this as being like a Newton's cradle, where you drop the ball at one end and it knocks all these things and the ball at the other end moves. So if that's what QE did and really pushed out asset prices, especially on the most risky assets, I think you're going to see the reverse of that. And that's one reason the long end of Treasury yields are behaving poorly this morning is people are starting to realize QT is coming, this balance sheet reduction is here, and that behaves differently than rate hikes and goes directly to asset prices.
Peter, can we talk a little bit more about that, particularly with respect to the paper that was presented over at Jackson Hole, talking about how this directly feeds to the leverage given to a lot of hedge funds, a lot of traders, and how that taken out of the market leads to a lot more volatility and a lot more sudden potholes in price valuations. What could we be set up for if it is as follows, if it is as fears in terms of the withdrawal of liquidity?
So I think it's going to do 2 things. One is it's going to allow everyone to move slightly down the risk curve, right? So if you wanted to buy dividend stocks, now maybe you can buy high yield bonds. If you're buying high yield bonds, you can buy IG bonds. If you're buying long duration bonds, you can buy 5-year treasuries. So I think you're going to see everyone move down the risk curve. So I think that is going to be tough for stocks to overcome. I think it's going to be very difficult for high yield and leveraged loans. I think we're going to be okay at the front end of the curve. So that to me is the main thing this is going to do, is allow everyone to shift down risk, and that's problematic. And then the other thing we're all going to be questioning is how liquid are these markets, right? Friday was ugly, but Friday was in a very thin market. And what I find most difficult to talk about is if you go back to last summer when the Fed insisted on doing QE, they kept talking about market liquidity as the reason to do QE. I can guarantee you that market liquidity, especially in treasuries, is way worse now than it was last summer.
Pete, I get very uncomfortable with a very comfortable consensus. 12 months ago, it was transitory, and now it's short and shallow. And this recession idea is something apparently for next year, for 2023. We've got a real sense of that in Jackson Hole, that everyone was lined up to say almost the same thing, Pete. What do you make of that?
I'm actually much more bearish than that, and I'm not bearish because of how I think the Fed policy is going to be. I think we've already turned the corner on the economy in a negative way. We're seeing things roll over, and I'm willing to bet that by December, we're complaining about deflation and real problems in the economy rather than inflation. I think we've gone too far too quickly. Things are turning, things are rolling over. I don't like what's going on in crypto and disruptive stocks. I don't like what I'm seeing in housing. So I think people are being far too complacent.
Fascinating. Pete, thank you. Peter Chi of Academy Securities. TK, he's essentially saying we've already made the turn. That this is not just about the Fed now. This has taken on a life of its own. And for Pete, at least, it could be a whole lot worse than this short and shallow consensus you hear so much of.
And that's, John, seriously, one thing I'm a little blurry on here is the state of the housing market. We've got housing data coming out this week. I understand that. But I just don't have a handle on how housing and rent fits in to some form of growth slowdown.
Well, before this plays into rents, Lisa, we might have to wait a while. And that seems to be the general view of a lot of people.
Yeah, and what happens while we're waiting, especially with financial conditions, especially with market functioning? And this is where the fear comes into play. When you start manipulating markets in this kind of way and removing some of the liquidity, do you get accidents? Do you get some sort of financial market disruption that accelerates a downturn in a way that perhaps is not exactly what the Fed would like to see?
To get inflation down, there's a price to pay. And they're willing to pay that price. And I think that was the main takeaway, Tom, after Jackson Hole on Friday and through the weekend, and not just from the Fed, but from the ECB as well.
Yeah, and what's going to save them is technology, John. Augustin Carstens, in his lunch speech, I thought was just brilliant. It recapitulated what he told Chris Giles in the FT, and he mentioned technology as being absolutely the separate feature. And I think the optimism that the optimists have is about technology.
Speaking of tech, Tom, do we have a rocket taking off in an hour and 20 minutes or not?
This is a huge, huge deal. Elon Musk's not involved. Jeff Bezos is not involved. What's involved is our collective memories. This is the new Saturn V rocket. And John, it is frozen on the runway right now. Associated Press out with a blistering story of cracks in the fuselage. John, that harkens back to the Challenger space shuttle disaster. Right now, at this moment, there are really, really nervous engineers at Cape Canaveral.
And Tom, you can tell us more about that through this morning with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures down 1% on the S&P, live from New York. Good to be back, isn't it, Bramo?
Yeah.
It's nice to be back. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Fuel leaks and a possible crack are threatening to delay the test flight of NASA's new moon rocket. The uncrewed Artemis 1 mission is set to lift off today from Kennedy Space Center. It's scheduled to circle the moon in an orbit that will take it deep into space and then return to Earth 42 days later. U.S. Navy warships have sailed through the Taiwan Strait for the first time since House Speaker Nancy Pelosi's visit to the island. That trip strained relations between the U.S. and China and led to Chinese military exercises around Taiwan. The Navy says its ships were demonstrating the U.S. commitment to a free and open Indo-Pacific. China is moving aggressively on COVID as a meeting of top Communist Party leaders approaches. Authorities are enforcing lockdown restrictions in areas around Beijing more intensively, and they'll mass test the port city of Tianjin. Elon Musk says the world needs more oil and gas now to deal with an energy shortage while it pushes to transition to renewable fuels. The CEO of Tesla told an energy conference in Norway that he's not one to demonize fossil fuels. Still, Musk said there must be a clear path to a sustainable energy future. Trademark filings suggest that Apple may have settled on potential names for its highly anticipated mixed reality headset. Applications were filed in a number of countries for the names Reality One, Reality Pro, and Reality Processor. Apple is aiming to release the headset next year. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
You know what's worse than high prices and a strong economy. It's high prices and millions of people out of work. I'm very worried that the Fed is going to tip this economy into recession.
Senator Warren, the Democrat from Massachusetts, on CNN. Are we going to hear a whole lot more of that in the months to come? From New York City this morning, good morning with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures down 1% on the S&P. On the NASDAQ 100 down by 1.25. Yields are higher on a 10-year by around about 7 basis points, 3.10. 0.80% on a 10-year yield. Your 2-year yield through the highs of the middle of June in the FX market. Your dollar was a little bit stronger this morning. It's weaker against the euro now. Euro stronger, 99.83, Tom, on euro dollar, with yields on the periphery and in the bond market a whole lot higher this morning.
In 20 minutes of deterioration here, John, you wonder if we're going to get out to the 3-0, the emotion of a 30 VIX. We're not there yet, 27.59. Right now, we're going to look at the economist, Senator Warren of Massachusetts, rather. I'm kidding. She is truly expert at bankruptcy law, but opining on the Fed. Jack Fitzpatrick joins us now, Bloomberg Government in Washington. Jack, this came up in sensitive moments at Jackson Hole, the independence of this Fed. Give us a clinic on how independent this Fed is in Washington.
Well, I think, for one, it is notable that, yes, you're hearing pushback and concern from a high-profile senator, but Senator Warren is kind of representative not only of the progressive wing, but she has her concerns and is vocal on monetary policy. If you're going to hear pushback from someone who's concerned that they're going too far with rate hikes, it's probably going to be Senator Warren. You are not seeing that, at least not yet, from leadership-aligned lawmakers. You're not seeing, it doesn't seem you're seeing anything from the White House that would express frustration with them. So maybe it's so quiet because it's August recess. Maybe we'll hear more from other progressives. But right now, I don't think this is truly a huge amount of pushback. It's notable, but I wouldn't say it's something that threatens the sense of the Fed's independence.
But if we get there, and I'm not, I've got my own opinions, I'll keep them out of it. But Jack, if we get to a growth slowdown of some flavor, this is equal opportunity. We've got the economist Warren from Massachusetts. We've got the economist from Kentucky, Paul, the libertarian, and they're on the same page. Jerome Powell's a piñata. What's going to be the level of piñata if we get flat GDP for an extended time?
I think you may see more blame from the progressive wing. This is an issue that lends itself pretty easily to Republicans blaming the Biden administration and the stimulus. That's the line heading toward the midterms. I think it would probably be the Republican line beyond that. So if you're seeing frustration with the Fed, if things get really bad, it would, I think, spread beyond Senator Warren, but it would primarily, and at least initially, come from the progressives, and it would be very notable if you hear it from leadership-aligned Democrats. I would suspect that Republicans would continue to be much more focused on criticizing the Biden administration than the Fed, given the politics of it all.
Elisa, we're not seeing more of this because unemployment is at 3.5%. We're not seeing more of this because everyone in the White House keeps saying the economy is so strong. The real test for the independence and support of independence of this Fed is if the mandate's in conflict. If you have unemployment that starts to climb higher and inflation's still sticky, how much do they support this Fed bringing inflation down? And how does this Fed communicate that higher unemployment is a price worth paying to get inflation down? That's when things get harder. That's when I imagine we'll hear more than just the likes of Senator Warren saying these things.
It's harder on both sides, though, because at the same point, Jack, you see right now this idea of perhaps the Fed could curtail growth or curtail the economy so much that it goes into recession. But if we start to see that and inflation is still high, what's the remedy? What more can the administration in Washington do to bring down inflation from the other elements, from the other sides, aside from just looking at the demand side suppression of a Fed policy response?
There are theoretical solutions, but if they could flip a switch and end the war in Ukraine or reduce supply constraints tied to uncertainty around the coronavirus and that kind of thing, they probably already would have. That's something that Senator Warren got into, and that is the progressive, maybe MMT-aligned critique of this kind of action by the Fed, is that it doesn't specifically target the key supply constraints, but how much can the Biden administration do if that's the case? In a perfect world, the constraints being applied by the Fed would not be necessary. You may hear more of that critique from progressives, but there's a reason this is necessary in the first place.
One thing, Jack, we're hearing a lot of criticism about is the student loan decision in the last week. Some reports, Jack, and I wonder what your reporting's indicating, that apparently the Secretary, Janet Yellen herself, didn't agree with the decision, and even the First Lady didn't agree with the decision. Where are those reports coming from?
I've seen a mix of reporting. I believe I had also seen some of our own colleagues reporting that some of the progressives pushing for this had been pushing the First Lady to get her on board. I'm not sure about that the First Lady's own opposition, because to some senators who wanted potentially even more than $10,000, $20,000 for Pell Grant recipients, they had sought out Dr. Jill Biden to get her on board. So there was a bit of a mix there. It was notable that there was some hesitance from the Treasury Secretary.
Yeah.
But overall, I think a lot of the conversation was something was going to happen. How high could they get that number? And clearly there was a lot of success, because they largely got this from $10,000 to $20,000. So the supporters clearly had a significant victory there.
Hey, Jack, thank you. Jack Fitzpatrick down in D.C. TK, once again, another example of the Treasury Secretary, Janet Yellen, being somewhat marginalized potentially on a massive issue.
Yes, I think it's very true. It's almost a shock, John, to see Yellen in the zeitgeist this weekend over the student loan debate. But it has been, to be polite, an odd Treasury. I don't really know what to make of it.
It's been a quiet one, Lisa. Let's be more diplomatic about it. It's been a quiet one.
Yeah. Well, perhaps silenced one, right? The sort of economics meets the politics. And when the economics and politics don't mesh correctly, maybe you silence some of the economics and go with the politics. Is that possibly what we're seeing?
Something like that. Futures right now, down 1% on the S&P. I'm behaving. I'm not saying too much.
I know. I'm impressed. You just don't let me throw myself
out. You wouldn't say too much either if you were that cold.
Live from New York City this morning. Good morning. It is feeling more and more like the middle of June. On the S&P 500 on Friday, the biggest one-day drop since the middle of June. On the Nasdaq 100 last week, the biggest weekly drop since the middle of June. And this equity market on the S&P still about 10 percentage points higher than the middle of June, but the two-year through the June highs this morning. Very, very close to 350. Your bond market looks like this. Your two-year right now in and around the year's highs at about 345, 344.77, yields up 5 basis points on a 2-year, on a 10-year, up 7 basis points to 3.1098%. Mike Wilson this morning putting out the note over the weekend for you all to read through this Monday for your week ahead, and saying the following: the first half was about the Fed. The second half is going to be all about earnings, and he thinks the scope for some disappointment, a lot of move to the downside still to come, apparently. And this Fed is communicating the following: we'll keep on hiking, and we'll keep on hiking into weakness. The ECB goes one step further over the weekend. Here's a snapshot of the euro. The ECB, an executive board member, Isabel Schnabel, suggesting that even if we face recession, we have to keep on normalizing to get inflation lower. This sets us up for a really interesting conversation on September 8th. The prospect of maybe, I stress maybe, a 75 basis point move. The conversation somewhere between 50 and 75. A report suggesting we could have a conversation about QT. And Tom, all of that with the real potential for that decision to be made going into recession.
In extra war, in energy, I really wonder the disinflationary impulse there in a different economy that is Europe. I wonder if they're going to get a real earful of disinflation there.
Going to be super difficult, Tom, to get any disinflation from the energy story anytime soon.
I want to set up the conversation with John Ferro. John, don't move. And this is the 12-month trailing return on equities. Things maybe not as bad as the gloom that's out there. Standard & Poor's a negative 9%, down negative 10%. NASDAQ's a bear market, negative 20%. And John, you made an observation that a bull like our next guest is on the same page as a somewhat bear like Michael Hartnett. Discuss that polarity where they're on the same page.
On one issue, Tom, they want this central bank to get control of inflation and get out the way. I think most people have agreed for a long, long time that they don't want a Fed to have the presence it has in this market. TK, to have an 8-minute speech from a Federal Reserve chair to move markets by this much tells you how much this market is still dependent on the Federal Reserve. And I think what bears and bulls and every market participant alike agrees on, they want to get away from this world, Tom. They want to get away from this world.
We'll have to see. Kathy Jones publishing moments ago with Charles Schwab, and she says, well, you know, John, it wasn't the Gettysburg Address. John, did you have to memorize the Gettysburg Address in school?
We didn't, Tom. Different education, different country.
Oh. Okay.
We learned a little bit about Lincoln, Tom, but not too much. Just a little bit.
That's good. You wanted the Lincoln SVDB penny. That's the one you wanted. Well,
you can teach me more in the commercial break. I can tell you that Evercore called that speech, not the Gettysburg Address, Tom, but they called it the anti-pivot.
The anti-pivot
speech. I like that. That's your cross-asset price action. Let's get you some moves. We can do that with Brammer this morning. Good morning, Lisa.
Good morning, John. You were talking about since the middle of June and where we are in the equity market. You talked about how the S&P is still 10% higher. The NASDAQ still 14% higher, has gained 14% since June 16th. How much do we get a reversal of that? I'm looking at some of the positioning, which is getting quite bearish in some of the big tech names. And you are seeing ahead of the market open today, the losses continuing from Friday when the NASDAQ was down almost 4%. Apple, Alphabet, and Microsoft all down more than 1%, led by Apple. 1.5% decline. How much is this the dual issue of not only the interest rates going up, removing some of their forward earnings that have been baked into their valuations, but also some of the semiconductor concerns that have been percolating and reiterated by every executive on earnings calls. I'm also watching the meme stocks, especially after Jeremy Siegel of Wharton came out and told Bloomberg at the end of last week that he sees a 10 to 15% allocation for meme stocks as being appropriate in portfolios. Not today. GameStop shares down more than 3%. Robinhood shares 2.4%. Coinbase, as tied to the whole crypto complex, Tom, down 3.4%. How much does rising interest rates really remove some of the froth that we saw, particularly from areas that already have been completely hammered, but perhaps have more to go?
No, we'll see here with futures deteriorating. Negative 33 is now negative 42 on SPX futures, right at the 4,000 level. Dow futures under 32,000, and the VIX it's out now 2 full points, 27.54. We had Andrew Sliman on before with Morgan Stanley with decades of experience. We recapitulate now with John Stolfus, Chief Investment Strategist at OpCo Oppenheimer Asset Management. We're thrilled John on short notice could join this morning. John, explain why you're not selling, that phone call. OpCo gets it. Go to cash. Sell everything. Go to cash. I've never done that in my life. Why do I not want to go to cash this morning?
Well, Tom, thanks for having me on the show today. I have to say this. We think it's good that the Fed is doing what it's doing. It's on the case. It's going after inflation. It recognizes it's going to take longer, as we look at it today, for the Fed to put inflation in check. But the main thing is they're doing it. And what that will likely do is it'll kill off the speculative pockets like the memes or all those multiple currencies, multiple cyber currencies and exchanges that were created. It looked like that. At one point, I think we had more cyber currency vehicles than there were automobile companies at the beginning of the early 20th century.
Okay, so right now you see that it will just take out some of these pockets of froth, but will leave the rest of the market fresh to rally anew. What will be the trigger at a time when we still haven't seen quantitative tightening really take hold, and there still is more hiking to be done?
Well, Lisa, I think you said it. It's a matter of a space on the timeline that needs to pass. With the Fed being active and addressing its benchmark rate and addressing the balance sheet issues. But I think the Fed is fairly determined here to put inflation in check, but I don't think it's aggressive in a negative sense. I think this is still the Ben Bernanke legacy Fed that's highly communicative. It's just that market participants, we believe, who on Friday were selling, it was a combination nervous investors, perma bears, as well as highly leveraged players, some of whom got burned in that huge rally that we've had from June 16th that brings up, double-digit returns for, I'm looking here, 5 sectors from that point. They got hurt there, and now they're going short again.
So, John, I'm looking at your
to take profits without FOMO for them.
I'm looking right now at your S&P target for year end at 4,800. How much pain are you willing to take? And what's your hedge, right? How do you sort of prepare for the possibility of being wrong?
Well, Lisa, you have to consider we don't live and die by a target on the S&P 500. That is almost a game that is played by the media and the strategists. It's a serious game because it talks about the direction for the Fed and how high we think it can go. But we're widely diversified across large caps, mid caps, small caps. We're growthier value and garpier growth right now, dividend stocks, and on a relative basis, we're doing quite well in the portfolios we manage under that premise. So we've got to say there's a good chance that we could see 4,800 if we go back and see, a rally off of this challenge to the rally. And it is likely, if you look at history, when we publish regularly the maximum drawdown figures for the markets, 2 pages now, going all the way back into the 70s.
Yeah.
Stocks can actually go up even as interest rates rise and as there is concern over inflation. I got into this business in 1983, so I've been through a bunch of Fed fund hike cycles. In the beginning, it's always rough. The naysayers always say the Fed is going to fail. But I recall that the S&P 500 was somewhere between 120 and 160. That was the level it was at when I got into the business. And on Friday, with all the drama around the selling that day, it closed at 4,057. So I think monetary policy can be effective and has been proven to be so, even though it can be wrong and have to make various points.
And John, it's very important to note that Stolfus is so ancient that the Dow was 1,258 points in 1983.
Hey, John, can you promise me one thing? That if we get to 4,800 year end, you still get to call this a media game as something you don't care about. We'll see, right?
Celebrate. You can't
right.
Celebrate small victories.
Hey, John, come on. Every single one of you puts out a year ahead outlook, and at the top, there it is. It's the price target. It's a media game. John Stolfus, thank you, buddy. It's always great to catch up of Oppenheimer Asset Management on the year ahead. You need the bullish view because right now, everyone's looking at this, and I think a lot of people are thinking the same thing. What's there to be optimistic about here?
Well,
you've got a Federal Reserve that's telling you they're going to hike into weakness. We've got the adjustment on rates already. You can see it at something like 345 on a 2-year in America. And Mike Wilson's lining up to tell you it's pretty obvious what happens next, isn't it? Earnings get smacked around. If the central banks, both the Fed and the ECB, are telling you, Tom, we're going to hammer growth, and growth's going to get hammered, and we're going to keep on hiking because we want to get inflation down. That's a difficult moment to feel like, hey, let's get long.
What is similar here, and you mentioned it earlier, John, is both the bears and the bulls are looking at corporate performance, earnings, margins, revenues. Will revenues be dampened by slowdown, et cetera? And the answer is the bulls fall back on one cardinal rule. Corporations in every case adapt and adapt rapidly. That will be interesting to see, particularly as an aside in retail with the holidays coming up.
And that's what supports the Stolfus camp, Lisa, that earnings have been resilient. Can you keep repeating that act through the next couple of quarters, given what this central bank's about to do?
Especially because talking about holiday time and retailers, I was looking at a number of surveys that talk to people spending a lot less on goods during this holiday season. So some of the concerns that keep percolating out from some of the retailers. Also, what does the strong dollar do, John? And I do wonder, given we have not talked that much about this and we're seeing the dollar at the strongest levels going back to 2002, how does that really affect some of the multinationals?
Do you think that's the next note from the investment bank over at JP Morgan? Year-end targets are a media game.
Well, you know, that could be one explanation. We could discuss what he could potentially come out to be bullish. You know,
so it's the media,
low,
isn't
discounts.
it? That drives me nuts.
Well, you know, it's a media game, but it's played to the media by a lot of investment banks.
Futures down 0.9% on the S&P.
Go
On the
to
Nasdaq
cash.
100,
Wait,
down
are
1
you in
full
cash?
percentage point from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Today's scheduled test flight of NASA's new moon rocket could be delayed. Fuel leaks and a possible crack were discovered during final liftoff preparations. The space agency stopped and started the fueling of the rocket multiple times. It's set to carry 3 test dummies on the 6-week mission. Senator Elizabeth Warren has taken aim at the Federal Reserve's plan to fight inflation. She told CNN she's worried the central bank will tip the economy into recession. Warren said there's something worse than high prices and a strong economy, and that's high prices and millions of people out of work. If an Iranian nuclear deal is reached, Tehran may be able to put millions of barrels of oil on the market almost immediately. It's estimated that Iran has up to 93 million barrels of crude stored on ships in the Persian Gulf, off Singapore and near China. A nuclear deal would most likely lead to Iran being allowed to sell oil globally again. And in California, Governor Gavin Newsom has introduced a bill to keep the state's last nuclear plant open. Newsom argues that keeping PG&E's Diablo Canyon plant operating past its planned closure in 2025 is needed as the state transitions away from fossil fuels. Still, Newsom's fellow Democrats in the legislature are skeptical. Honda and South Korean battery maker LG Energy Solutions will spend $4.4 billion to build a battery factory in the U.S. The Japanese car maker wants to phase out fossil fuel vehicles by 2040. The location of the plant hasn't been decided. Bloomberg reported in June that Ohio is a front runner. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I think we need to move, and we need to move methodically toward a clearly restrictive stance, which we're doing. And then, in my view, then we either pause, depending on the data. We're going to have to see how this plays out. We get to above 3.4 by year end, or at or above 3.4, and then we see.
Patrick Harker of the Philadelphia Fed going into the weekend on Friday from Jackson Hole. Live from New York City this morning. Good morning with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. The Jackson Hole Chair Powell fallout continues. We're down 0.9 on the S&P. On the Nasdaq 100, down more than 1 full percentage point, and yields are higher right the way through the curve. 2s out to 10s. Your 10-year up 7 basis points to 3.11%. On a 2-year up 5 basis points, just short of 245 right now. Tom, a little bit earlier, just short of 350. Came very close at about 348.
Any number of data points to touch on. How about Bitcoin under 20,000? That gets my attention, 19.796. Haven't done anything on that. We'll see. The crypto show tomorrow, I believe they're going to schedule it even with BitDog under 20,000. Right now, as we look to China, a chart on China. Here's Kriti Gupta.
Yeah, we got to talk about the ripple effects of Jackson Hole and Chairman Powell's extremely hawkish comments. Well, those ripple effects went around the world, specifically to China, where you are looking at a Chinese yuan that was fixed at 6.9. It now has a sight set on that key 7 level. It's an important intermediate step to 7. For my chart of the day here, we're looking at the difference between the PBOC yuan fixing and the average estimate in Bloomberg surveys. For our radio audience, I'm going to give you some numbers here to really visualize what I'm trying to show you. The difference on an average day in the last 6 months or so is about 25 pips, so basically going out to the 4th decimal place. In the last 4 days, that has gone as high as negative 120 pips. So it really shows you that this is a market that has been consistently surprised by what the PBOC is doing as it tries to really stabilize its currency and prevent it from that weakening. The ripple effects of that, Tom, go to the Japanese yen, go to the Korean won. Ultimately, as you start to see the 2 largest economies diverge in their monetary policy, this is going to become a trade story for a lot of these export nations.
Kriti Gupta, thank you so much. There is a nuance of currency, of depreciation and devaluation. A depreciation is assumed with a floating rate currency, and a devaluation with a more and traditional fixed rate currency. China is somewhere in the middle, What we know for certain is there's been a 14% depreciation or devaluation, I'm going to call it, in the renminbi, that going back to 2014. Enda Curran is living this in China and joins us right now, our chief Asia economics correspondent. Is the system there, Enda, normal enough where Beijing cares about Chinese devaluation, or is it so removed within a totalitarian regime that it's not normal economics?
It very much cares what the exchange rate does, Tom. Remember a few years ago in 2015, they allowed the market more room to move the yuan around a little bit within a range. Of course, all the fundamentals at the moment suggest China's currency should be weaker. The authorities have allowed that to some extent. But now what's happening is that they are coming in and making sure that they are putting a floor on it for stability purposes. Because, on the one hand, they obviously don't want to import inflation. The PBOC has said, although China doesn't have a real broad-based inflation problem at the moment, they certainly don't want to start importing it via commodity prices. And on the other hand, of course, it's all about financial stability. They don't want to accelerate outflows out of China's bond and securities markets. That's already been happening at a fairly rapid clip. And then to the point that was just made, the yuan is a regional anchor. Ever since the Asia crisis in 1997, when they chose not to devalue, which was seen as a very important decision at the time, stability in China's yuan does help stability among its key trading partners in the region as well. And that certainly is among the factors as to why China is thought to be keeping it somewhat where it is at the moment.
So this is really complicated, Enda, especially because we've just seen a decades-long monetary regime flipped on its head in every which way, including the desire for a weaker currency to increase exports. Now a desire for a stronger currency so that you don't import that much inflation. How is this going to play out when it starts to affect the trade situation? In other words, stronger yuan, perhaps less trade, less exports from China. At what point does that become a conflict?
Yeah, so this is undoubtedly the big question, Lisa. Later in the year, if exports are softening, will the authorities then tolerate the yuan where it is, or will they allow it to weaken? This is a big question, I think. The real test will come later in the year when trade is expected to slow down. Trade has been one of the pillars of China's recovery over the last few years, and that's expected to come off. And if that does start to happen, then you might see the authorities under pressure to let the yuan weaken as well. There's no doubt about it. So I think trade is a big part of that story.
Well, when we talk about trade, we also were talking last week about some of the power outages, particularly in Sichuan, and how they were slowing down some of the manufacturing output. That's coming back online. However, you are seeing around the rest of the nation, lockdowns are re-ensuing in places, even in, like Beijing, certain crackdowns as they try to keep COVID under control. At what point does this have a permanent effect on the factory to the world reputation of China and really lead to structural changes of a lot of international companies?
Well, it's another day, more announcements of restrictions and lockdowns, Lisa. Like you just mentioned, and the state press were out today saying, look, the government is sticking with this COVID zero policy, dynamic COVID zero. Everybody else has to stick with it too. Tianjin under more restrictions and testing. Shenzhen, next door to Hong Kong here, the world's biggest wholesale electricity distribution markets under restrictions and a kind of a lockdown in there at the moment. Economists are downgrading their forecasts now for China. Median forecasts of 3.5% for the year. Real estate's in a slump. We've just mentioned the impact from extreme weather. Exports expected to slow down. And of course, ongoing COVID zero. You might suggest something will have to pivot at some point soon, but at least in COVID zero, there's no hint of a turn on that at all. As I mentioned, the state media made clear this morning that there's no room for turning on that. Congress is coming up in November. It's hard to imagine China would really want to allow a public health disaster ahead of that.
And thank you. The brilliant Enda Curran late into the evening in Hong Kong. Enda mentioned the quarterly survey of economists that we conduct here at Bloomberg on growth going forward for a range of countries, including China. Those expectations, projections have been lowered all the way out to the third quarter of next year. Lisa, the number that Enda mentioned, 3.5%, that's the median. That's down from 3.9. And we've mentioned the forecast from Goldman and Nomura a few times, but just to remind everyone, Goldman's something like 3% GDP growth this year. Nomura has a two handle. I think it was 2.8%. for GDP in China this year.
Wasn't it Billy from Milken who came on and said that nobody on Wall Street, or most of the analysts, are not going to lower it below 3%, but it is a political move more than it is a fundamental economic move because they don't want to be seen as so bearish. The question is, when does it get back above that level? And that's also what's getting, to your point, being lowered progressively throughout the years. This is really concerning, not only for China, but also for global growth projections.
It's the old take on Wall Street, Tom, when it comes to Chinese data, that if it's good, it probably isn't, and if it's bad, it must be really bad.
Yeah,
and right now, that data's not good.
Well, it's not good right now, but as Leland said, maybe it's a lot more accurate than we care to believe. I don't know, but I do say, John, the veracity of the data, I just think top to bottom is suspect. And you see that with, stuff that doesn't even make the headlines of where a given operation is being bailed out by a company you and I have never heard of, which clearly is related to the government.
With you, Tom, things are so complex right now that these bigger stories are sort of out there on the periphery and don't even make it into the headlines.
They do. This is true. And I think that what we have to fall back on is the data of Bloomberg surveillance. Was that good?
That's great. Futures down. This is Bloomberg.
Wound up from the cold tent.
Somehow we have to find a manageable pathway down to a lower level of inflation.
I think we have seen the peak. I think it is going to moderate, and I think we can all hopefully look forward to that.
The people that are saving don't need the money. The people that pay the interest rate can't afford it.
We know that a lot of the supply side constraints are outside of the purview and the mandate of the Fed, and that's where the problem emerges.
Given where spreads are and given the amount of contraction that we've seen, we definitely think that there could be trouble ahead.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. The market move continues off of Friday's Dow 1,000 points, a VIX out 2 points earlier. John Ferro, it's not just stocks, bonds, currencies, oil, they move.
Take your pick, Tom. Foreign exchange early this morning, the dollar the strongest, going all the way back to 2002. Early this morning, the two-year yield the highest since 2007, taking off the June 14th highs. Tom, we take them out. Back around them right now at about 345. Became very close, just 2 basis points away from having a little look at 350.
And what's interesting here, John, is with the calendar. We've got to get out, and what's so important is out is not to the next Jerome Powell press conference. Out is to September 8th because Europe matters to America.
The ECB, they've both got one priority, to hike rates to get inflation down. And, Tom, they're willing to tolerate a slowdown in the economy. How much are they willing to tolerate that? That was the big effort over the weekend. We've got one priority, get inflation down. And I think they really wanted to communicate, Tom, that the hurdle, the bar to pivot, the bar to pause is a lot higher than you think it is.
1939, 12. John, how do you raise rates into a war?
How do you raise rates into a recession? That's what the ECB is about to do, Tom, in the minds of many.
Lisa, you took the Gulf Stream back. What'd you read about this weekend that matters to you after Jackson Hole?
I think the big discrepancy right now is people who believe that this economy can withstand a 4% interest rate for a longer period of time, for 2-3 years. And that, I think, is really the feeling right now between those. And I wonder how much John Stoltzfus represents really a more bullish tilt of, yes, these companies can sustain it, and perhaps some of the game stocks and some of the ultimate corners of froth will get beaten out, but not necessarily the mainstays of the economy. And then you have others that say, no, this is going to be painful. There is going to be a downturn, and that is going to be difficult for companies to stomach, regardless of who they are.
Not that I can remember because I was frozen, the hot tang not helping me. But John, Mr. Bullard says front load. What are we front loading into if we see a sustained level for 1 year, 2 years, 3 years, is a number of people talk about?
Tom, it's into the unknown for 2023 and beyond. They're focused on one thing, and I think Jim Bullard really tried to push this one home. We asked him about the longer-term neutral, that dot at the end of the dot plot. Tom, he doesn't want to go there, doesn't even want to talk about it.
Right.
He doesn't even think there's much value in those kind of projections. We have to deal with what's in front of us right now, CPI 8.5%, and rates in his mind and many on the committee that remain too low.
Below parity on the euro. Let's jump into the data, John. I'm going to look at dollar BBDXY, which is a really good set of math on EM currencies as well. Truly out to record dollar strength this morning. John, sterling 117 exactly. That must be because Harry Kane missed that penalty shot. Euro 0.9996. John?
Hard to keep up with the price action, Tom. Some negative follow through from Friday into Monday. Equity futures lower, down by 0.9%. Negative on the NASDAQ by 1.2%. The story of the equity market, lower, lower, much lower. Of the bond market, yields higher, higher, much higher. Just short of 3.1% right now. We faded a little bit from the highs of this morning. Yields still higher by 6 basis points or so. Euro's a fascinating one. I just do not know what to do with euro dollar. Euro dollar 99.95.
Yeah.
We've got yields on the periphery breaking out this morning. The ECB reportedly set to discuss QT. Set to discuss a 75 basis point rate hike, set to hike rates into a recession. Even if they see one, they're willing to keep on going.
Right.
Does that mean you buy the currency, Tom, or do you sell it?
Very quickly here, John, what's interesting is the diffusement of a currency, not against a major pair like euro dollar, but the summation of the dynamics of euro Czech, euro zloty, and on and on and on. All of those micro movements around euro will matter here.
So the Czechs, Tom, have the rotating presidency of the European Council this year.
Right.
And they're trying to call a get-together of the energy crisis, Tom. The energy crisis is not going away this year. And, Tom, I would suggest that what we heard over the weekend from the SNB governor, Thomas Jordan, is that we might have to face the consequences of higher inflation for a lot longer, maybe several years. That's a new conversation, Tom, in the last couple of months.
Yes.
Not just on the energy front, but on the inflation front. This might not be a one-year story.
Right.
It might be a multi-year story.
Well, let's get to that right now. She's out of Georgetown Finance and enjoyed Harry's Italian Pizza Bar for 5 years at the New York Fed. That makes her qualified to talk about rates. Megan Swiber joins us with the Bank of America Director of U.S. Rate Strategy. Where's your x-axis? Not the y-axis, the level game and all that. Where are you on the continuum of U.S. rate strategy?
So, Tom, what I think we need to take in mind here is that Powell delivered this very clear message that the Fed is going to do what it takes to get inflation down, even if that means paying for businesses and households. In our view, we are expecting a mild recession to occur later this year into next year. And ultimately, that's what the Fed needs to do to basically get inflation back down.
You think back down to what, though? Megan, do we get back down to 2% with a mild recession?
Yeah, John, I think that the Fed needs to ultimately target that 2% level. And as we heard Powell discuss last week, right, they're not looking at moving the inflation target. They're going to do whatever it takes to accomplish that. I think that the Fed will likely keep hiking until they really see progress being made here. And as we heard last week as well, they're not looking at even just the recent cooling in inflation as anywhere near a victory just yet.
So, Megan, with that in mind, and as we start to think more about the appropriate time horizon to guide inflation back towards target, what does that mean for how you push that view right the way through the curve, 2s out to 10s?
Yeah, John. So what we see right now is the Fed topping out between 3.5, 3.75 or so. That's still going to mean that the 2-year has more room to go higher. But at the back end of the curve, we also need to see the markets price this risk of recession, of the Fed ultimately needing to move rates back down at some point once they have reached their expected inflation rate, once they have reached target, and they have moved unemployment well above those longer run averages. Ultimately, we think that the Fed will probably deliver cuts beginning in the second half of next year. But really, for now, the market is still very focused on where this terminal rate is necessarily going to be.
Megan, this is rather shocking because basically Fed Chair Jay Powell said, in so many words, we're not going to cut rates. Stop thinking about that. We're going to hold rates high for a very long time, or for as long as it takes before they see the whites of disinflation's eyes. How much can you have this conviction around the idea of rate cuts, given the conviction of Fed speak against that?
Yeah, Lisa, and part of why Powell's been pushing back on this, and other members of the committee have as well, is because they're forecasting this soft landing. If you look at the SEP dot plot, from June, what you see is that they're able to hold rates at that 4% or so level well through 2024. But that's because it comes with only a very modest move higher in the unemployment rate. That is a very, very optimistic picture, and thinking that that's all it's going to take to get inflation back down to target.
Okay. But Megan, and I apologize for cutting you off, but if this is the case, if we see a very hard landing,
Yes.
a steep downturn, which is what you're saying, that will lead to rate cuts by the second half of next year, does that mean that inflation will also be back down, or will this basically be the Fed blinking and saying, in the face of weakness, we're not going to keep rates where they are?
Right, Lisa. So what we're envisioning is that this mild recession does what's needed to cause inflation to move back down to target. You have to think of the composition of the inflation basket here, right? On one hand, we're seeing the improvement in supply chains help put downward pressure on goods, but really it's wage pressures that are keeping services elevated. And in order to engineer that cooling in services, we need to see the unemployment rate move higher. And ultimately, we think that that will bring inflation back down towards target. That doesn't mean, though, that the Fed can't cut with inflation modestly above target. That's because the Fed's going to get to a terminal rate that's still very aggressive, something close to about 4% or so, right? And that's well above the Fed's longer run expectation of where that neutral rate is. So they could still have a modestly aggressive policy stance with the Fed funds rate, say, at 3% instead of 4%.
So, Megan, just to be clear and put a bow on it all, you're not questioning the reaction function of the Fed. You're not doubting that. You're questioning the forecasts.
Yes, John, that's exactly right. So what we see is that the Fed's expecting this very soft landing. We think that that's going to be very hard for them to achieve. What we generally see is that most Fed hiking cycles end with something like a recession. And that's what we're expecting this time as well.
Megan Swiber, awesome. Just a final word. You said there was some upside here on a 2-year. 350 almost this morning. Can you just put a number on where you think that upside is?
Oh, there you go. Getting in trouble.
We see it at around probably 275 or
oh,
so.
Come on. You can't go to 4% on the way to 275?
375, right?
Or, excuse me, the Fed funds rate, we see that as around 375.
And the 2-year as well?
Yes, it could probably get up to 3.5% or so.
Okay, good.
Yes.
Very close this morning. Megan Swiber of BofA. Megan, thank you. Good to go through that. There's a very important difference between questioning the reaction function or even doubting the reaction function that was communicated going into the weekend by this Fed and Lisa, and just questioning the forecast. And Bank of America are just questioning the forecast, as everyone is free to do so.
Well, and perhaps the market is largely doing that as well, because you're not seeing a huge reversal, although you are seeing some. So at what point is this the Fed able to get ahead of a narrative while also being behind on the projections of what the economic outlook will look like?
And that's exactly what Peter Schiff of Academy was doing earlier this morning as well. Yeah. He thinks that weakness is right here, right now. We've already made the turn.
Yeah, although, again, especially with balance sheet unwind, it's unclear how quickly they can pivot, even with rate cuts.
The future's down 1% on the S&P 500, on the Nasdaq 100, down about 1.23%. Live from New York City with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Payroll's Friday, just around the corner. Only mentioned that a couple of times already this morning. More still to come on the labour market in America. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Today's scheduled test flight of NASA's new moon rocket could be delayed. Fuel leaks and a possible crack were discovered during final liftoff preparations. The space agency stopped and started the fueling of the rocket multiple times. It's set to carry 3 test dummies on the 6-week mission. U.S. Navy warships have sailed through the Taiwan Strait for the first time since House Speaker Nancy Pelosi's visit to the island. That trip strained relations between the U.S. and China and led to Chinese military exercises around Taiwan. The Navy says its ships were demonstrating the U.S. commitment to a free and open Indo-Pacific. And China is moving aggressively on COVID as a meeting of top Communist Party leaders approaches. Authorities are enforcing lockdown restrictions in areas around Beijing more intensively, and they'll mass test the port city of Tianjin. Elon Musk became the world's richest person in large part through his electric car company. Still, at an energy conference in Norway, Musk said he's not one to demonize fossil fuels.
I do think we actually need, and actually at this time, I think we actually need more oil and gas, not less. But simultaneously moving as fast as we can to a sustainable energy economy.
Musk spoke as Europe is grappling with its worst energy crisis in decades. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Inflation is extremely high, sort of unimaginable. The levels we're at were unimaginable 18 months ago. And so we have to get that under control. That's job one. That's our top priority.
That is job number one. That was Raphael Bostic, the Atlanta Fed president, speaking to us in Jackson Hole, Wyoming, just this past Friday from New York City this morning. Good morning, live on TV and radio with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures lower 0.9% on the S&P 500. If you are just tuning in, we have a little bit of an equity market sell-off here, down by a little more than 1% on the Nasdaq 100. Yields higher by 5 or 6 basis points through much of this morning. Let's round this one up for you. Your yield on a 10-year 3.1%. The euro 99.87, showing just a little bit of strength, up by 0.2% on that currency pair. Going into the ECB next week on September 8th, with a 75 basis point rate hike on the table to discuss. The prospect of QT being discussed as well. Just want to mention payrolls this Friday, Tom. For those out there that missed that estimate, 300k is the estimate still. It's come up a little bit from the guide of last week as the numbers pour in, Tom. The number goes higher.
How do you have a recession with 300,000 units non-farm payroll? I don't get it.
Clearly, that's very difficult to call that a recession, Tom. The question people ask, though, Tom, is whether the labour market is lagging, and you're already seeing the pain developing that's ultimately going to spill into the labour market sometime soon.
Bloomberg Surveillance has been committed to economics. We're really looking forward to giving the Jackson Hole treatment to Sintra when they come around again in Portugal. And at those efforts, there are academics. We avoid them like the plague. We do that for all sorts of reasons, but every once in a while we get lucky and lasso in one of them. At Jackson Hole this year, Francesco Bianchi of Johns Hopkins, ex-Duke, ex-Princeton, stopped traffic by speaking the word that no one wanted to speak, and that is fiscal economics. It's a 29-page paper loaded with math I don't understand, matrix algebra. We just can't do that on TV, but we can talk about the basics and the policy prescription out of this. You say there can be a monetary-led solution or a fiscal-led solution. Within MMT, does the Fed do a fiscal-led solution, or is that the part of Congress and the president?
So right now, I think the Fed is committed to bring inflation down. I guess the main point of our paper is to show that the Fed also needs cooperation from the fiscal authority. So we take an historical perspective and we look back at the 60s and 70s and provide an argument that there was a fiscal phenomenon, ultimately. It was dovish monetary policy, but combined with overspending and no commitment to that stability. And so now the question, the Fed is acting, is moving interest rates up. So our question in the paper is that if going forward, we will see the necessary fiscal adjustments to bring inflation down. That would be the fiscal solution to the problem.
What did you learn from Stephanie Kelton's MMT? This has been all the rage. The media loves to pick on it. There's a political polarity to that. You come from the neutrality of Europe, of Italy, Costanzo over in Portugal, and the rest of them. So you're the foreigner looking in at the debate of MMT. What have you learned about MMT in this crisis?
So I think what we learn I think all of us, what we learn is that fiscal policy can be extremely powerful. Fiscal policy arguably put a stop to the low interest rate environment. We were for 10 years at the zero lower bound. In fact, with risk of deflation, I think we tend to forget where we were 1 year ago. The Fed was genuinely concerned about deflation. We intervened very forcefully with fiscal policy, and that contributed to the solution. Of course, it caused a big jump in inflation, arguably because it compounded with some exogenous forces like the pandemic, of course, the supply chain problems, the Russian conflict. But ultimately, fiscal policy proved to be a very powerful mechanism. I think what we learn, on the other hand, is that this comes with a cost. And the cost is inflation. Now, it's always easy to do policy with the benefit of hindsight, but with the benefit of hindsight, probably we went a little bit overboard.
Well, Francesco, there's a really profound implication here. It's not just what the response was, it's the expectation in the consumer's mind that there will be more fiscal stimulus if there is another downturn, and that is what is going to lead to inflation expectations becoming unmoored. How much does that really crimp the ability of policymakers to either add fiscal stimulus in the face of a recession, mitigating some of the downturn, or B, going for the fiscal stimulus of the past few years and leading to inflation that's much higher than it has been in the past?
That's an excellent point. And in fact, what we emphasize is what really matters is long-run fiscal sustainability. So what we want is to be able to use this powerful mechanism during recessions. But in order to do that, we need to guarantee that overall, in the long run, or at least in the medium run, we are on a stable path. So what that implies is essentially that when things are good, when we don't need to provide fiscal stimulus, we should refrain from doing that exactly to keep this ammunition to when we need it.
I got one quick question. I saw Richard Claret at Jackson Hole, and I want to go back to the core of your paper, which is DSGE. Richard Claret has worked with Gertler and the rest.
Right.
How can we trust this math? All the mathing smart guys like you are doing. Has it been proven wrong given these shocks that we've seen?
So I don't think so. I think the math is just a way to formalize some ideas. So what we are discussing here, I think, is something that everybody can relate to.
Right.
People had first ideas and then came the math. So the math is only a way to put order. And
Right.
I don't think that DSG models or more in general macro models in themselves have failed. If anything, there are some risks that we forgot about.
Okay. And John, it's important. Oh, Lisa, good news. I just got it. The car to take you to the Abramowicz house to explain matrix algebra to Lisa's kids, it's waiting.
Francesco, thank you. Francesco Bianchi there. On fiscal policy and what it means for inflation expectations. Lisa, I wonder what that means for Europe as we get into this energy mess, and ultimately we're all looking for fiscal policy to offset some of the pain.
Yeah, you've been talking about that. So if you're looking at an inflation problem, and Francesco's point is well taken, that additional fiscal support exacerbates this expectation that policymakers will jump to the solution, to the rescue in the face of trials and tribulations, it will allow inflation to go further up, even if it temporarily mitigates the pain of some of the higher gas prices.
I'm going to push against that, John, in that I think there's so many unknowns now and so much uncertainty. I really question the core mathematics of Gertler Claret and what we see from Professor Bianchi. The uncertainties out there and shocks to the system right now, are, off of a natural pandemic, are huge.
We'll keep this conversation going.
Yeah,
Sam
exactly.
Stovall's going to join us, the Chief Investment Strategist over at CFRA. If you're just tuning in, where have you been? Your equity market's lower by 0.8% on the S&P. On the Nasdaq 100, down by a little more than 1%. We're fading a little bit here. We're off the lows on the equity market. We're off the highs in the bond market. Yields higher still by 5 or 6 basis points, but below where we were earlier this morning. On your 10-year, 3.0949%. And the euro showing a bit of strength. Back through parity. Euro dollar positive, 0.5%. From New York City, this is Bloomberg. From New York, this is Bloomberg Surveillance on TV and radio. I have to say, as the session grows a little bit older, things get a little bit better for the equity market bulls.
Yeah.
We're lower now by 0.8% on the S&P. The Nasdaq off the lows, down not even 1 full percentage point now on the Nasdaq 100. Very close. Yields off the highs as well, up 4 or 5 basis points at the moment to 3.09%. The euro a bit stronger, dollar a bit weaker as well. Euro dollar back through parity. A break to the upside, 100.16, positive 0.5%. Setting you up for payrolls Friday. The latest estimate is 300k in our survey. This is what Citi's got to say. Andrew Hollenhorst publishing moments ago. Assuming a decent jobs report, he says the following: whether the Fed hikes 50 or 75 will depend on September 13th. Quote, used car prices will likely weigh on the core reading, but strong advances in shelter and other services keeps us expecting a 75 basis point increase. I have to say, Tom, whether it's 50 or 75, I think the message from Powell is bigger than that, away from September. It's we've got a job to do, we'll do more work. It would be premature to back away anytime soon, and even if we get the weakness, we're going to keep on hiking.
Totally agree. Neil Ferguson wasn't at Jackson Hole, John, but let's do a Ferguson counterfactual. Why did the market move right away when Powell spoke? Why did it take 2, 3, 4 hours for boom?
For boom, Tom?
Down 1,000.
I don't know. You want me to explain things tick by tick? I can't help you.
I was just surprised we didn't see the reaction right away, frankly.
We got it in the end, didn't we?
Yeah.
Getting it again this morning.
Yeah, it follows through this morning. Futures negative 32. The VIX was out 2 big figures, 27.30. I'm not going to be gloomy and say we're on the VIX 30 watch. We're not there yet. We are lining up people with equity experience. That would be Sam Stovall, Chief Investment Strategist at CFRA, and we really thank him this morning on short Dow down 1,000-point notice. Sam, as you think to a Monday morning, as you write to September, what is your lead theme given the volatility?
I think the lead theme is that we end up retesting the June 16th low. But right now, our belief is that we do not set a lower low. So right now, increased volatility. It will be a September to remember. But I think we will get through this okay.
The hallmark of your father's work and your work and CFRA's work is corporate analysis. Explain your confidence in margin resiliency at corporations to the end of the year and into next year.
Well, you're bringing up a good point because here we are just beginning the final month of the third quarter. Earnings estimates are expected to be up 4.3% for this quarter. However, 6 of the 11 sectors in the S&P are predicted to show some declines. But when we look at the profit margins, they've actually held up exceptionally well. In the second quarter, profit margins were expected to be down 5.3%, and they were pretty much in line. So we are expected to see some continued whittling in profit margins, primarily as inflation remains fairly sticky, as price hikes for inputs, et cetera, are felt by corporations. So the real question is what kind of damage will be done to earnings and profit margins as the year progresses.
Well, and the year progresses, a key aspect of that is how the Fed responds and how much the Fed hikes rates, how much they tighten policy, how much they confirm and act on the message that Jay Powell was sending on Friday. How much does that shape your narrative? How much does that shape what you are willing to buy and how bullish you can get?
Well, right now we're expecting a 50 basis point increase at September, but obviously knowing that could be a coin toss depending on the data that comes out between now and then. Maybe it gets revised to 75. But right now it's a 50 estimate for September, 25 for the remaining 2 FOMC meetings this year. But important is that the Fed will keep a higher Fed funds rate through 2023 and possibly early into 24 as they want to make sure that they can strangle inflation. So I would tend to say that right now, momentum models are continuing to point to inflation hedge sectors like energy and materials, but also to the defensive staples and utilities at the expense of the more growth areas of communication services, consumer discretionary, and tech.
So, Sam, you're buying energy equities. Is that what I'm hearing from you? This is an interesting call, given what we're hearing out of Goldman right now.
Well, I think you have to look to the energy stocks, not give up on them for a couple of reasons. One, they still offer a very nice dividend yield, but probably more important is if you look to the absolute PE ratio versus long-term history, the S&P 500 energy sector is trading at a more than 50% discount. When you look to a relative PE ratio, the numbers look pretty much the same. So it ends up, unless you think that energy is going to just stop being of interest to investors, I still think there's a long-term opportunity.
There are two schools of thought here. On one hand, you have the people who say energy structurally is going to be a winner just longer term based on what the supply and demand would say. On the other side, if you believe in a recession, you believe that the equity markets will penalize oil. And that's definitely what we've seen, at least over the past few weeks. Does that matter to you, the idea that the Fed has to materially slow the economy and that it's already slowing naturally because of inflation, and that will be bad for demand and bad for energy prices?
I think that the closer we get to a recession, and if you look going back to World War II, every time the year-on-year percent change in headline CPI exceeded 6.5%, we had both a bear market and a recession. And while the bear markets ended up being deeper on average when it was accompanied by recession, not all of those bear markets ended up being 30% plus. So ditto for the depth of the recession, if there is one. Our economists are basically saying that it would end up being fairly shallow, and as a result, probably not have the kind of disruptive demand aspect toward energy as one might expect.
Sam Stovall, there was a chart out this weekend which reminded me of your legendary father and, quite frankly, John Maggie of the 1940s. And it was a collapse of RCA out of 1929. Every generation has an RCA. Are we too arrogant that we feel this time is different?
Oh, no. I mean, whether it's Penn Central, whether it's Drexel Burnham, et cetera, there will be, or Bear Stearns back in 2008, there usually is some sort of a collapse that ends up signaling a lap bell, if you will, to this bear market. We have yet to see that, and I think that it's something that we probably will end up seeing. Maybe it's an international bank, maybe who knows what kind of company it might be, or something a little closer to the 21st century where it's something that is more crypto related. But we have yet to see that. You're absolutely right.
Yeah, we're not talking crypto this morning, Sam. It's under 20,000. We're going to ignore that. Sam Stovall, speak to the institutional audience. Give us an update on the efficacy of a 60-40 portfolio.
Well, I think 60-40 is still something for investors to be focusing on. Yes, this is a rare situation in which you had bonds down 27%, you had the S&P off 24%, but still bonds offer ballast to an overall portfolio. And go back in years, every time that we did have a sharp sell-off in the bond market one year, we ended up with double-digit returns the second year. So bonds do tend to snap back very quickly.
Sam, thank you, sir. Sam Stovall of CFRA. Just want to all get you up to date, up to speed on the latest around that NASA launch, Tom. They were set to send a rocket around the moon. It was at risk of delays about an hour ago. They found a couple of issues, Tom. They were wrestling with a few issues over there, TK. And the latest is that they've had to call off the rocket launch for this moon orbit test flight.
I'm not surprised at all. I was thunderstruck by the Associated Press article that was out, 2 hours ago. One, and not to get into a science exercise, but this is hyper complex. The complexity, the Rube Goldberg structure of this is totally different than Saturn V. And what's key, John, is you've got solid fuel down below. Let's leave it at that. There's a lot of people that aren't fans of it. And up top, you've got supposedly safer liquid hydrogen, liquid oxygen, except one of the pipes has a crack. And that harkens back to other disasters we've had before. I expected this, and this thing has been troubled, John, from day one. Because, like, John, surveillance runs like a Swiss watch. I mean, it's just the way it is.
I'm sure it runs just like NASA, Tom.
Yeah, but NASA doesn't run like a Swiss watch. There's real complexity.
Let's just say that we're not
here.
Efficient astronauts like those guys must be executing this show.
When's it launch? Who knows? It's been troubled from the get-go.
There's a bigger issue here, though, and it goes to the idea of policy, and that this is a public endeavor. It is not Elon Musk. It is not Jeff Bezos, as Tom, you were saying earlier. But, John, I think this is important. This is a federally backed foray back to the moon and trying to get this back up and running with space exploration, and speaks to this larger push for technological investment on a national scale. I find that an incredibly interesting aspect of this particular launch.
Well, a small setback this morning, as Tom described. According to officials, NASA were investigating a potential crack in material in the main body of the rocket, as well as a possible temperature issue with one of the main engines. As they grapple with that, Tom, they've now scrapped the launch. So that's NASA dealt with. Let's deal with the market for you. The S&P 500, down 0.75% on the S&P. Wasn't even going to try. The Nasdaq 100, down 0.9% in the equity market. And Lisa, yields a little bit higher by 5 basis points. We certainly fade, though. The equity market off the lows of this morning, and the bond market yields are off the highs of this morning.
Yeah, after the violence of Friday, how much do we really get a shift in tone versus Tom's question, which is legitimate, which is why was the reaction delayed? What were people reading into that 8-minute speech as they parsed over the words, or was it just the algos needed some time to get up to speed?
Well, perhaps they actually read it. because the more the more I read it, and I've read it about 3 times now, the more I read it, the more it was just a direct attack on this moment we're in right now, and a direct pushback against any of the criticism that came about from maybe some mistakes made in the news conference. I think we can say that, based on how this was framed. Just line after line, Tom. He was pushing back against this idea, we'll cut anytime soon, we'll loosen anytime soon. Pushing back against this idea that if they see weakness, they'll pause. Just none of that in there at all.
John, in New York tonight, there's a moment, and it harkens back to the heritage of England, and that is tennis. Serena, it's 7 p.m. tonight. Extraordinary.
Awesome, Tom. And I was very lucky to watch her in opening night a number of years ago.
Very cool.
Just very, very cool.
Very cool.
I have to say this, though. Has anyone tried to buy any tickets for the US Open this year? Because I was shocked by how expensive they are.
Yeah, they're really expensive.
I looked at the same tickets I got last summer, and they have doubled for the same weekend.
It's
which
outrageous.
Is absurd.
I keep waiting for Emma to call.
I am not
Emma
going.
hasn't called.
I'm not
Emma
going.
just hasn't called.
Unless those tickets come down. And of course, this is the secondary market, which is difficult.
Are you pleading for someone to?
No, I wouldn't accept them at all. This is the secondary market I was looking to pay, and they've doubled. What do you want me to say? We're not going this year, guys. That's it, the end of it. Tony Dwyer's going to join me around the opening bell from Canaccord Genuity. Looking forward to that. Futures off the lows.
He's bearish.
Down 0.75%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Goldman Sachs says buy commodities now and worry about the recession later. Goldman analysts say that recent declines in raw material prices offer a great entry point. They also see the risk of recession outside Europe in the next year as relatively low. In California, Governor Gavin Newsom has introduced a bill to keep the state's last nuclear plant open. Newsom argues that keeping PG&E's Diablo Canyon plant operating past its planned closure in 2025 is needed as the state transitions away from fossil fuels. Still, Newsom's fellow Democrats in the legislature are skeptical. Honda and South Korean battery maker LG Energy Solution will spend $4.4 billion to build a battery factory in the U.S. The Japanese car maker wants to phase out fossil fuel vehicles by 2040. The location of the plant hasn't been decided. Bloomberg reported in June that Ohio is a frontrunner. And more on that rocket launch. Today's scheduled test flight of NASA's new moon rocket has been scrubbed. Engineers were focusing on a problem with one of the rocket's 4 main stage engines. The countdown clock was stopped at 40 minutes before a potential launch. The mission is set to carry 3 test dummies on the 6-week mission. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Good morning, everyone. Bloomberg Surveillance, Lisa Abramowicz and Tom Keene. And there is breaking news, and this out of Europe. We're watching Europe and the ECB to September 8th. But Lisa, this is von der Leyen saying, do something, a power market emergency intervention. Lisa, translate.
Yeah, it's a European project coming together, the European Union preparing the power market for an emergency intervention. This is by the European Commission President Ursula von der Leyen at a meeting today. And how much does this really read through into specifications that we do not yet know, including the removal of certain emissions caps and is also a regulation, a little bit more of how high prices could go, Tom.
We celebrate now, and we do this of Washington, and whether conservative or liberal, we celebrate someone who, in this geriatric Senate that we have, is doing the right thing. Leahy of Vermont will retire, and he's retiring with his full abilities at 82 years old, and he retires with a wonderful memoir for all. The Road Taken, a memoir, Senator Patrick Leahy. We welcome the former DJ at WSSE St. Michael's College, Patrick Leahy, this morning. Senator, I want to cut to the chase. The liberals of your youth, Scoop Jackson of Washington, HHH of Minnesota, and a young Leahy have been substituted for the new progressives. What do the new progressives need to learn from the liberal theology you lived?
Well, I think they have to learn that you can talk about doing things or you can do it.
Yep.
Accomplishing things, accomplishing legislation is more difficult, but it requires you to stop talking accept with each other, work out. Both Republicans and Democrats try to get coalitions and pass things. I mean, you go way back to the time of Lyndon Johnson getting civil rights bills passed, and he had a number of senators who supported segregation and all. He brought people together, but it required some hard work. Humphrey and Jackson did the same thing. They would bring in Republicans and work with them and get it done. I worry that, and I appreciate a number of things the so-called progressives stand for on climate control and education and all. But it's one thing to talk about it. It's another thing to accomplish it. And you have a lot of these things you have to settle for 85% this year in legislation, get to the other 15% next year. It's never an all or nothing game.
Senator, do you think that President Biden is the right person to take that country and lead that particular effort post 2024?
Well, he's gotten a lot of great legislation passed. He's lowered the deficit in many ways. And most importantly, he brought us back into the world of nations. Look at the animosity Mr. Trump has shown toward NATO and other countries and his favoritism of Russia. And since Joe Biden came in with a clear view of what Russia is like, what Putin is like, with Ukraine, he brought the NATO countries, our European allies, together in a way we haven't seen in decades. And I know that totally surprised Vladimir Putin, but it also showed that the United States was back in a leadership role.
Senator, there are a lot of people speculating that perhaps he shouldn't be the person to run again for 2024, specifically because of the fact that he is older and that he isn't necessarily generating the same enthusiasm, and we're certainly seeing that in the polling. Do you agree? Do you think that it is time for new leadership?
Well, I think if Joe Biden wants to run again, I'll support him. That's a decision only he can make. It's the same way I had a lot of people urge me to run again in Vermont, but it's a 6-year term, and I have things I want to do and still do, and so I retired, probably at the top of my influence in the Senate as President pro tem. But Joe Biden's going to have to make that decision himself. But I can't think of anybody, any of the people who ran, including the former president, who could have brought NATO together the way he did, and could have gotten some of the legislation we've passed and everything from COVID to child nutrition. I mean, name it. I don't think anybody else could have done that the way he did.
Senator, we are out of time, but I urge you to speak again to Bloomberg, to David Weston, and all of us about The Road Taken, a memoir. It is really extraordinary. I can't say enough, folks, about how it is of a liberal of another time and place. The gentleman from Vermont, Patrick Leahy. Lisa, it was too bad we had to cut it off there. We've got so much market movement here, including a surging euro, Lisa, off the headlines from Brussels.
Important headlines about the European Union working together to restructure the electricity grid in Europe. That is the goal here, as laid out by Ursula von der Leyen. We're also getting comments from Olaf Scholz of Germany saying that they must look very carefully at ways to dampen power prices, talking all about just how important it is from a structural level in Europe and the cohesion around Europe, perhaps giving some lift to the euro today.
And we're seeing it with the euro, and also a rebound here, the yield rather lift in the yield decline, I should say, in the German 2-year reverses with a little bit more enthusiasm.
We should also add, and just to note that the euro surge that you're talking about, it's now above parity, right? We now have above 1 versus the dollar. We're also seeing gas prices, natural gas prices plunge by about 20% in the European project today as a result of some German stockpiles that actually increased more than people had previously expected. How much to sort of give some steam to those declines?
No, we can do that off the Bloomberg, and I mean, that's what we try to do here. I'm looking at Netherlands nat gas, which is maybe a little dated, but I'll take it. And, you know, we're a little bit off the peaks here of a couple days ago. It's still above some of my moving average studies, but we'll see how that evolves. What we know and know for certain is Europe matters. We've been to Jackson Hole, and of course many articles written about the importance of the visitors there from Europe, and we will do all we can to get to the jobs report on Friday and then on to that important, that critical ECB meeting. Futures, negative 34, the VIX 27.17. Stay with us. This is Bloomberg.
Welcome back to another special U.S. Open update from Bloomberg TV and Radio from Tennis Channel. I'm Johnny Ray Diaz. The 142nd edition of the U.S. Open kicks off Monday in New York. Serena Williams will take center stage under the lights on Arthur Ashe as he takes on Danka Kovinic. The 23-time major champion will retire from pro tennis when her tournament ends at Flushing Meadows. And you can guarantee there'll be a full house to witness what could be the legend's last match and honor her remarkable legacy. Coco Gauff is also in action Monday as she takes on France's Leolia Jean-Jean in the second match of the day on Ashe. On the men's side, all eyes will be on Rafael Nadal as he looks to extend his lead in the all-time list at the Slams. The Spaniard's looking for his 23rd major crown in the Big Apple. And don't forget, Tennis Channel Live at the U.S. Open hits the air daily at 9 a.m. Eastern. I'm Johnny Ray Diaz.